Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith. And here are three things you need to know this morning. GameStop shares are plunging after the former meme stock darling fired CEO Matt Furlong and elevated Ryan Cohen to executive chairman. Cohen, anointed by the Reddit community as the meme stock king, originally founded pet food retailer Chewy before joining the board of GameStop in early 2021. He hired Furlong in a bid to boost sales at the embattled video game retailer. Its latest results showed a revenue drop and a narrowing of losses in the fiscal first quarter. In 2020, a mixture of short seller panic and retail investor fervor drove the shares up astronomically amid the COVID-era's meme stock mania. The market melt-up taking a breather as investors assess the Fed's next move. The Nasdaq was weighed down by higher Treasury yields on Wednesday, thanks in part to an unexpected decision by the Bank of Canada to hike rates. This after the Bank of Australia did the same thing earlier in the week. The prospect of higher interest rates in the U.S. is not good news for growth stocks in general. They're by definition fast-growing and rely on steadying funding streams that become more expensive when rates rise. The Fed's widely expected to pause rate hikes next week, but these moves show entrenched inflation could remain a problem for months to come. And the veil of smoke blanketing large parts of the U.S. East Coast has not dissipated yet. It has the potential to cause more travel delays in the coming days. The FAA this morning announcing another ground stop at New York's LaGuardia Airport as the smoke from Canada's wildfires spreads. Yesterday, it halted operations for several hours. The U.S. National Weather Service has issued air quality alerts across the Atlantic seaboard. President Joe Biden also tweeting that citizens should take precautions and listen to local authorities.
Well, shares of GameStop plummeting this morning. The company fired CEO Matt Furlong and named Ryan Cohen as executive chairman. The announcement came the same day that it reported a drop in revenue and narrowing losses in its fiscal first quarter. Cohen, founder of Chewy, joined GameStop's board in January 2021, the same month that saw the company's stock surge to an all-time high. Cohen quickly became a luminary for the meme stock craze. His cryptic tweets have been tracked and deciphered on Reddit forums. In a cryptic tweet sent half an hour after Furlong was fired, Cohen wrote, "Not for long." We're joined by Yahoo Finance's executive editor, Brian
it wasn't that cryptic. It was a play on Furlong.
Yeah. Play on Furlong.
It wasn't for long.
Sure, it wasn't. But at the end of the day, I mean, we've seen, of course, from the meme stock craze all the way to how they've tried to reposition the company as a more digital sales focused versus the brick and mortar, which has been slumping and a challenge for retail across the board. And at the same time, you're not really hearing from executives. There was no conference call after these earnings dropped last night.
No conference call. And what we did hear under Furlong, under his, I would say, brief tenure, is about, at longest, an 8-minute earnings call. So he was not a big believer in earnings calls either. But the story here is this, and we're not going to be able to fit it all into 2-minute saying, so I'll just come out and say it. Ryan Cohen has been basically a complete failure as a board member and as an executive at GameStop through and through. Stock price down 58% since she got involved in terms of a chairman in the chairman position in June 2021. This is a board that is completely controlled by Cohen and various other people. And we have a graphic set up for that. Various leaders that he worked with at Chewy, he put them on the board. You have Cohen up there, of course, leading the charge here. Those are some of the executives on the screen right now that have been tasked with trying to save and turn around this company. Complete, utter failure. Now, they came out here, they tried to get into the digital asset marketplace. Failure. They have come out and tried to open up new warehouse distribution centers to improve fulfillment. Failure. They are now closing facilities. You have failure in terms of the first quarter here. Sales down 10.3% year over year. You have software sales plunging. Their big initiative in terms of selling more collectibles or little figurines that usually sell for about $5 in the stores. Failure. Those sales down in the most recent quarter. So through and through, this has been a horribly run company under Ryan Cohen. And I go back to 2019. Ryan Cohen was in this studio, Yahoo Finance's studio, 770 Broadway, New York City, talking about the Chewy IPO and some of the initiatives he stood up at the company. And I think it's a playbook he has tried to run at GameStop, again, with complete failure. Take a listen to what he told us in 2019.
The strategy from the beginning is really replicating the experience I had in the neighborhood pet store, but doing it online and doing it at scale. And so, doing those small things like the handwritten holiday cards and the flowers and the pet portraits, really showing our customers we care about them, we care about them, we care about their pets, and we never want them to dream of shopping anywhere else for their pet products. And so pet customers are fanatical. That's the ecosystem that we've built. That's really the foundation and the soul of the company.
And that right there is the face of failure in GameStop. And he has not, I think, He has not communicated with investors. He has not earned the trust of these investors, these everyday average investors that have put in many cases, their life savings into a company that they still think to this day, despite the stock price being way down under Cohen, thinking they're going to turn around. It's not going to happen. There is unlikely any turnaround at this company, and you cannot cut costs, close stores, and think you're going to be a successful retailer over time. They operate about over 4,000 stores around the world. And as long as they have that amount of stores, that amount of operating leases on the books, you are not turning this company around. It's that simple.
At one time, none of this would have mattered.
Mm-hmm.
At one time,
GameStop doesn't matter, Julie.
At one time, none of this did matter to the people who were buying the shares, what you're saying, because it was really a faith story, right? And I think this morning's reaction in the shares illustrate that it is no longer a faith story. The fact that the shares are selling off, the fact that the one-time fans of the company, maybe they're still fans, maybe they're still out there, but they're being overwhelmed by people who are selling these shares. And I just want to mention as well the short picture here, because that was such an important part of the picture early on when the narrative was this was the small, mighty investors, retail investors who were fighting against the big bad hedge funds who were shorting the stock. And there we're showing the short interest ratio in purple there versus the stock price in blue. We got some fresh data this morning from Ihor Dusanowski over at S3 Partners who tracks short interest. Short interest in the stock now at about $1.5 billion. That's about 22% of float, which is quite high. But he says the stock borrow utilization is over 95%. So most of the available borrow in GameStop has already been taken down. So in other words, the stock is so shorted that there's not a lot of shares left available to short because people are shorting this so heavily, but you're not seeing the squeeze that you once were.
Well, I would argue that there were never really any fans of GameStop, even throughout that short squeeze. It was people who were hating against the big player out there, the institutional investor that had millions, billions of dollars to throw around in short positions and could do so knowing that they had much more weight. However, they fell asleep at the wheel. And that's when a lot of the fanfare that emerged from the Reddit retail trading frenzy, whatever you want to call it, when that emerged as an opportunity to go directly up against the higher power or the big man on Wall Street, if you will.
Yeah, I'll have more to say in tomorrow's morning brief because I'm going to continue discussion in our newsletter tomorrow morning. But bottom line is this, you're seeing the stock price reaction, and you're right to call it out, Julie, a complete, I think, finally, loss of confidence in Ryan Cohen being this operational magician that he's going to come in here and save GameStop. This is a structurally challenged market that GameStop is operating in. There is no real reason for me to go into these stores and buy anything. That is a completely different case than Chewy. If I buy a pet, I need to feed the damn pet. It's a totally different case than GameStop. And I know a lot of these lovers out there in GameStop are going to rip me to shreds on Twitter. They continue to do it. I am curious on why you continue to have confidence in Ryan Cohen. You're probably sitting on a lot of losses. Look at the sales declines of this company. Go back over last year's 10K. You can see this is a very fundamentally challenged and problem company. Bottom line is this, Ryan Cohen does not deserve your trust. And I think it's time we hear from him. It's time for him to get out of the shadows and start speaking to investors and taking it seriously.
He's tweeting. No.
Not seriously.
Saz, as always, fiery on the
Thanks for having me on the show. It's really great to be here.
Thank
you so much.
Thanks for coming on. I hope you don't get too much hate mail.
Bring
All
it
right. GameStop's performance over the last 2 years baffled markets, of course. It behaved at times irrationally, seemingly at the whims of social media-centric investors, and bucked traditional expectations with Ryan Cohen at the helm. So the question is, now that he's taken over entirely, is there more GameStop stock tumult on the horizon? What does it reflect as well about the retail investing environment? Katie Kaminsky is with us now, chief research strategist at Alpha Simplex. And she reminded us all back in 2021 that GameStop's wild performance is a reminder that the behavior of investors is a powerful force in markets. She's here with us in studio today. Katie, thanks for being here. A powerful force indeed, although, as I said, that behavior seems to now have shifted, as is evidenced by the drop in the stock this morning.
Well, I think it's so fascinating because we saw one of the biggest moves for particularly hedge funds back during this GameStop event, and it feels as if from the institutional side, you're just not seeing as much fervor. And so I think you really put it very clearly that, back then during COVID, maybe, everyone's on the screen, everyone's thinking about it. Maybe everyone's back in the office. They're, not as focused on some of the key themes that they were thinking about back in COVID. I mean, I know we're seeing less of that fervor. It's much more about a Fed fervor these days, perhaps, than GameStop.
And so where does rationality re-ensue in the markets then, as people are not in front of the screens as much as they were previously and perhaps being a little bit more judicious about the investments that they're making?
Well, I think the challenge is that irrationality, that fervor, that optimism, it moves around, right? And so what we've been seeing is most of the focus right now is on a Fed pause, fear of missing out. What am I missing in the equity markets if we actually see less tight conditions? So back in COVID, maybe we were all focused on which of these companies are the next big thing to follow, or where is there too much shorting pressure in GameStop. But right now, it really feels like people are just trying not to miss out because of what you've seen. I mean, look at the Nasdaq. It's gone up so much. And now even Russell in the last week. I mean, so it feels like there's a little bit of FOMO. And that fervor, that optimism is much more about not missing out on general equity market performance this year.
Yeah, that's a really interesting point. You're not the first person lately to have brought up the FOMO trade, or some people are calling a melt up. That's what we've been talking about. But that's a really interesting point, that the FOMO trade has been transferred from these little individual stories to the overall market. So I guess then the question becomes, how long can that sustain a rally if it's just everybody saying, I don't want to miss this?
Yes, I mean, so everybody has been sitting around all year kind of saying, like, when it's going to be okay, let's wait, let's see, let's wait. And what we've seen now is, now that there's an indication there might be a Fed pause, everyone's saying, oh, everything's going to be better. What I worry about is that the market is often much more excited and optimistic in a much shorter period of time than what we see, because we're still seeing some negative signals in, say, fixed income. So if you think about where we are right now in terms of technical signals, equity signals are just very strong on the long side, but we're still seeing short signals in commodities until about a week ago, and also in fixed income. So the picture isn't really that clear. But if we don't have as much pressure for the Fed, then, hey, maybe it looks a little better, and everyone's just going to hope that inflation will just come back down and everything will be nice and rosy again, I guess.
Is the Fed still pressuring the markets, or is it the other way around now? Is the market pressuring the Fed? Because the Fed doesn't want to surprise the markets overly, but at the same time, the Fed, even in its dual mandate, it's seeing employment hold up relatively well right now and still combating inflation right now.
I would actually say it looks to me more like the market is pressuring the Fed in saying that, I mean, if you think about it, the Bank of Canada comes out today being stronger. And basically the market is basically saying, like, everything is looking good, just as long as you keep your pause. And that to me feels a little bit more like a pressure, because if they don't, that's where the people will be worried. Let's say that they come out and say, look, we decided to hike. People will be upset, and then they'll start hoping there's a pause after that, I guess, would probably be my guess.
Hold that thought. We're going to talk more about this. Katie, stay with us. The Bank of Canada actually shocked markets with a 25 basis point rate hike yesterday, joining the Reserve Bank of Australia in continued tightening paths in an effort to tame inflation. The moves by these central banks are sending yields higher as investors rethink their bets on rate cuts later this year, and even consider the possibility of more tightening from the Federal Reserve. We're back with Katie Kaminsky, who is the Alpha Simplex Chief Research Strategist and Portfolio Manager here. So as we weigh the different central bank policies that are being moved forward with throughout the world, if you're the U.S. now looking at what other entities are doing, what does that set up for the talks at the next meeting here?
Well, I think what's interesting today is you're thinking about a situation, bets that they would actually hike were very low until recently. I heard a stat today, it's roughly around 30% view that they might still hike. And that has creeped up a lot. Another thing to note, in the last 2 weeks, interest rates have been going up as well. So the market is really starting to focus a little bit more that, hey, wait a minute, data is not a slam dunk here. It is not clear that inflation is going to go down quickly. We're in a very difficult situation in that as long as inflation stays high, the Fed's mandate is to regulate it. Thus, we're probably going to be here longer than people would like. And as long as we're sort of hoping that things will pause, then people are buying because they're thinking it's probably not going to be that bad.
So let's talk about the implications for the bond market of all of this, which you touched on a little bit before, because there's a lot of other things that are at play in the bond market. In addition to just watching the Fed, there's the fact that the Treasury is now going to be selling, $1 trillion worth of securities that got sort of backed up during the debt ceiling situation. So what are the implications for not just bond prices, but also the sort of competitive nature of equities and bonds here?
Well, I think the biggest challenge this year is that you've seen that the bond markets and the stock markets have disagreed. Stock markets have looked like we're probably going to get a soft landing, let's figure this out, whereas bond markets, with the inversion in the curve, have been, in some sense, warning us of a recession. And so what we're seeing now is that stock markets are looking pretty strong, but bond markets have to react if we should actually pause or have less tightening. So just think about it this way. Inflation's high, the Fed pauses. What happens to long-term cash flows? They're at risk, as long as we don't see inflation go down fast enough. So I think people are underestimating the potential weakness in fixed income. And this is particularly true during rising rate environments, something that most of us haven't seen throughout most of our investment career. Looking at statistics over empirical periods with higher inflation, fixed income struggles when you have higher rates and when you have inflation. Thus, I would expect the longer end of the curve to break out. We're getting closer to there now. We've seen a little bit of movement more recently, although earlier in the year we hit close to a 4% on the 10-year. The question is going to be, could we eventually have a breakout where we have a steeper curve?
But at the same time, isn't there really a support under the bond market right now because people want that yield?
I agree there is, but I think I've been asking this question over and over again internally in the office. When is this going to happen? When are we going to have a steeper yield curve? And I think what we think is that it's going to take a realization from investors, wait a minute, inflation is really going to stick around longer. Wages are going to be stickier, wage pressure, and thus you'll actually have to think about the implications for long-term cash flows. So far, the market still hasn't realized that yet. Hit 4% on the 10-year and see if it keeps going, and I think that could be an indication.
Just a really quick follow here. If we're getting a steeper yield curve, does that also mean lower probability of recession?
Let's hope so.
Because you're talking about some other factors here.
Yes. We have always been saying that we think the bond market is going to be the first to fall. So you're looking at first, equities look good, they're very optimistic. Then people realize, wait a minute, inflation is sticky, that's not great for everything. What's the catch? That would be the bond market actually bottoming out. So we would see the bottom of the bond market first. And then after that, in the wake of that, if we don't have sufficient growth, then that's when you're going to see equities are going to be at risk. The problem is that's a multiple step question, whereas right now where we are, most investors are just thinking about the next quarter, thinking like, okay, this is looking good.
They always do. Yeah. Well, let's move on to economic growth outside of the U.S. for a moment, because China's economic recovery is raising some red flags for investors as well. But the expectation of monetary easing could change the trajectory for stocks. The country's biggest banks lowered interest rates on yuan deposits today. This as regulators also vowed to push for more open markets. Remember, on Wednesday, China's exports for May fell below more than expected, with a 7.5% year-over-year contraction as manufacturers struggled to find demand abroad over growing geopolitical tensions with the U.S. Katie Kaminsky still with us, Alpha Simplex Chief Research Strategist and Portfolio Manager. So when we look at the China data that we have been seeing, now a little bit of stimulus coming in, how much is that going to blunt the impact of some of the negative data that we have been seeing?
So what we're seeing so far is we've definitely seen the yuan has increased relative to the dollar in the recent period. We're also seeing that what has been the most tricky for me to understand is commodities, because commodities have been somewhat under pressure until about recently, the last 2 weeks or so. So I'd say that the general narrative has been disappointment from overall potential demand in China, but you're starting to see a little bit of uptick in prices of commodities. So I think that could be an indication that some of that disappointment may be able to ease a little bit. I think people were just over optimistic about how quickly this would happen and how fast demand would come back. And they kind of forget that even if demand comes back, this is still a system that is a little bit struggling, trying to figure out inflation across the world and tightening policy, which isn't an easy place for a recovery.
What does the weaker than expected export data that came out of China signal about some of the commodities price action that we may see in the near term now?
So you've seen, particularly in the industrial metals like copper and energies, you've seen a decrease in price recently, particularly since this narrative came about. You've also seen weaker signals in Asian equities than you have, with the exception of Japan, let's just be honest. And so we're definitely seeing those trends in the markets that we follow, that you're clearly seeing that some of that is coming into prices, which also can help the inflation data until it doesn't.
And it's not just energy, right? I know that you're watching some of the other commodity prices. I think you mentioned iron ore. That was something that you were looking at. So it's not as though we're seeing commodity prices across the board go off a cliff or anything like that. We've seen them kind of range bound in the case of oil prices, but what are you seeing elsewhere, and what does that indicate to you?
So I think when people have been asking me, what are the biggest trends? I've said long stocks, short bonds, short commodities. And the short commodity trade has really looked like a recessionary trade. And what's been interesting in the last, say, 2 weeks, as risk on has come back into the markets, perhaps as some ease on that demand narrative you just talked about, you've started to see big moves in some of the commodities. Iron ore was up about 8% since the beginning of this month, and that's a pretty big jump. You've also seen energies coming back after they've been under some pressure, but also range bound in more recent periods. So you're definitely seeing commodities move in the other direction for the first time in the last 2 weeks that we haven't seen.
Why hasn't this had a bigger effect on inflation? I mean, the longer term trend decline in commodities. And I know they're transitory and it takes them a while to feed through to stuff. Is it just that upward pressure on wages is so persistent? Like, what's going on there?
So we were talking a lot about inflation during this entire narrative since 2020. And what's really scary about inflation is that it moves. So it started in the commodity sector. It moves to another part of the economy, and then sometimes it moves back. So that's what we have to think about when we deal with inflation, is that price pressure goes from one area to another, and it basically right now it may not be in the commodities, but it could come back, and then you have, again, these cycles where you end up with commodity super cycles, which have this dampening and magnifying effect on other parts of the economy. And that's why I always like to look at them as the first mover until you get another wave. So watch them for that in terms of if you wanted to see another wave, having higher oil prices would have the potential to do that as well.
Yeah, no, thank you.
Yeah, exactly. Is there a commodity, though, that you would look to outlast even the super cycles that you're talking about, that has fared best in previous kind of waves that you've monitored?
Oh, that's a good question. I mean, I think some of the more diversifying commodities are a little different. So we've seen definite waves in agricultural commodities. We've seen very interesting waves in the industrial metal sector, such as copper, that's been very linked to China. But you also see energy as something that I think that's one to watch, because that's one that everybody's really paying attention to. I mean, we were talking about GameStop. If there's a commodity that investors care about, it's oil. So I think that's probably the one to start looking at first to see if that type of move could actually accelerate.
So to kind of put everything together here and kind of distill what you've been talking about. So you're recommending a long in U.S. equities, right? Short fixed income, if I'm understanding you correctly. Within equities, are there particular areas that are more and less attractive?
Well, if you look at the recent trends, the markets that have actually been up the most are things like the Nasdaq, so tech, but you're also seeing sort of a catch-up effect in small caps. So the Russell 2000 has been quite a bit this month, as an example. What we've really seen is this fervor for equities that has come back in the face of a potential pause. So that has been a very strong momentum signal in the markets. When you think about fixed income, I tend to be the sort of contrarian there with fixed income. I believe that during rising rate environments, until we have a steeper curve, you need to be very careful about holding long-term debt, because long-term debt is very susceptible to inflation. If you have any views that inflation might stick around longer, I would be a little careful with fixed income.
Yeah, unfortunately for all of us on the inflation front. Katie, thanks so much for coming in. It was so good to see you in person. Really appreciate it. Katie Kaminsky is Alpha Simplex Chief Research Officer, Chief Research Strategist, and Portfolio Manager. Thanks, Katie. Coming up, Tesla shares had their 9th straight gain yesterday. Will strong China sales numbers continue the party? We shall see. We've got that and other movers next. Oh, just a couple minutes till the opening bell. We're watching shares of Tesla today. The EV maker saying it delivered over 77,000 cars in China last month. That's a 2.4% month-over-month rise, according to Bloomberg. The shares breaking a 9-session winning streak here. It looks like in the pre-market, they're up over 80% year to date, but still well short of the record high in November of 2021. That was the closing high was 409.97 from that point in November of 2021. During this 9-session run, it's up about 23%.
Yeah.
So then falling back a wee bit in today's session.
I mean, we've heard Elon Musk say that the company can deliver 2 million cars in 2023. We since then have also heard him kind of moderate or waver a little bit on exactly where that figure would come in at, 1.8 million. We had heard him say that as well. And so China's going to be a critical part of this. And why, especially in a very competitive car purchasing region, is because there are additional mandates for production within that region as well for the number of manufacturers to continuously on a year-over-year basis produce and sell more electric vehicles as they combat with their own, as they combat climate in their own way. Looking at EVs is one of the ways in that region that they have decided to move forward. And for that means Tesla is going to face even stiffer competition, not just from some of the local manufacturers, but also from some of the overseas and U.S.-based manufacturers that are looking to bring some of the vehicles and models with the best brand equity, such as Ford bringing an edition of their Ford F-Series over into China, electrified as well here. So.
Yeah, and also I should mention there's a Spanish newspaper that's saying Tesla's in talks with the regional government in Valencia.
I was just there.
I know you were. That's why I thought of you when I saw that story today, that they might be building a factory there. Volkswagen also planning to build a factory in that region. There is the opening bell here this morning. Anyone who is in New York City today is lucky to be inside, like those folks there at the New York Stock Exchange, because we are still under an air quality alert here. There you're looking outside. I believe that is in the environs of Times Square, if I'm not mistaken. And you can see Astor. Oh, it's right here at Astor Place. There you go, looking down Lafayette there at the hazy skies of New York City here. I'll have to check on, while you're doing your hit at the interactive there, Brad, I'll have to check on the current air quality index here in New York City, which is expected to improve maybe a little bit today, but still something that we are witnessing here. What else are we witnessing in terms of the opening bell on this Thursday morning?
Well, this morning we're taking a look at the major
change.
averages. Yeah, not a ton of change on the Dow. Flat just barely to the downside here on this Friday's Eve. The Nasdaq Composite, though, celebrating Friday early, slightly, moderately, and responsibly. It's up by about 0.1% right now for the tech-heavy average. The S&P 500, you're seeing that flat just barely to the downside at this point in time. So we'll continue to watch that on at least early in trade here on the day. Let's take a look at the heat map, though, for some of those S&P 500 sectors, as we always do. Just giving you a glance of those 11 sectors for the S&P 500 as we begin today's activity. And it looks like technology is leading the pack right now. XLK up by about 0.4% here early in trade. You're also seeing real estate, though, on the other side of that spectrum, pulling up the caboose. Real estate down by about 0.9%. We've got much more coverage on the homes and real estate side next week throughout our special looking at real estate and a new reality here as well here. But as you're seeing here on the screen, largely mixed. Looks like we've got as good of a split as you can get for 11 sectors, but we'll continue to track that as that is moving here earlier in this morning's activity. Also taking a look at the mega cap tech stocks. Apple right now, that's higher by about 0.4%. Amazon up by 1.4%. And some of the other major players, Microsoft, Google, seeing fractional gains for Microsoft, fractional declines for Google. And then lastly here, let's just check in on some of those EV players as we were speaking about Tesla here on the day. There you're seeing Tesla to the upside, flat, barely to the upside right now by about 0.1%. But some of those other players, you had mentioned Volkswagen as well, Julie. So let's take a look at Volkswagen, and that is up by about 1.5%. We'll call that on the day. Some interesting activity happening elsewhere in the sector, but not so good for where was it at? Nikola, yeah, that's down. All right,
QuantumScape down 10.5%.
Yeah, interesting. All right, so we'll continue to watch these EV plays here.
Yeah, we will. And I've had the chance to check the AQI, which, as you said yesterday, we're all learning about the air quality index here in New York City right now, 209, which is not great. 50 is the usual, but it's a lot better than the 392 I saw it go up to yesterday. So that's where we're at. Let's talk about another mover, Brad. Shares of Rent the Runway plunging this morning after the company's sales forecast for the second quarter fell short of expectations. But the online fashion rental retailer did report a slimmer loss than expected. A lot of this has to do with discounting that the company had been doing to get people attached to a new plans that they rolled out, and now they're going to be decreasing that discounting. So there's the expectation that there might be some attrition, but the CEO, Jennifer Hyman, no relation, saying that the people who are going to stick around are going to be the people who are going to pay for the plan. So we'll see if that all works out. Yeah, and Jennifer had talked about the financial transformation over the past several years as well, but believing they're in a strong position to invest the majority of their resources into that strategy of improving the customer experience. The question is, and it comes back to your point of what the base of that customer looks like. If you do see
see some roll off or some attrition or churn in the number of customers, how much and on what type of spend are you expecting the existing customers or the remaining customers to put forward here? But they're reiterating their fiscal 2023 goals, 25% ending active subscriber growth, and almost 50% reduction in cash consumption on their path to being free cash flow break even.
Yes, for those who have watched the show for a while,
yeah.
You know, I'm a longtime customer of Rent the Runway, right?
I'm a fan of it.
And I'm happy with the new plans, I will say.
Yeah.
The customer service is usually pretty solid. Their app and their website could use a little work in terms of speed and ease of use. And their inventory, now that they've increased the number of things that you get in a shipment,
yeah.
the inventory could use a little bit of bulking up as well, I would say.
Yeah.
So
There's a new, and man, the name escapes me. There's a new men's offering that's started to come around as well. I've seen it kind of getting into my social media feed, so I need to investigate that a little bit more.
Yeah.
But finally something on the men's side. This has been great though for some of the women who want to make sure that it's staying fresh, but at the same time, you know, not breaking the bank, I suppose.
Not breaking the bank and not like consumption. You're renting,
right.
So you're not just filling up your closet.
It's an ESG play for your closet.
There you go.
Carvana here. They're getting a boost this morning after the company updated its financial outlook, now expecting total gross profit per unit above $6,000 in the second quarter of 2023 and adjusted EBITDA above $50 million here. Let's break down some of the other numbers for everybody's favorite car dispensary or
Car dispensary. I
mean,
like that.
of sorts. Yeah, vending machine is what they call themselves, or at least acknowledge that they are. But anyway, improved Q3 or Q2 2023 financial outlook as well, and updating some of these numbers ahead of that particular conference. They're also looking to see total gross profit expected to be above that 6,000 marker. That is a new company record. They're saying that would represent an over 63% improvement compared to the second quarter of 2022.
Yeah, the company has $8.7 billion in debt. So this is kind of what it is struggling with. It got rid of a debt exchange offer because it seems like it's leaning into some of the cost cutting and savings initiatives that it has put in place. But some stats on Bloomberg said that the interest on its debt cost it more than $2,000 per car in the first quarter. So that's not great.
Yeah, not good at all. But I mean, I'm continuing to try and kind of compare this and what they're seeing with even the data that's come forward from the Census Bureau and retail sales and vehicles, and where there could be some reinitiation of interest among consumers. It's still going to have to come at the price point where the new vehicles, or at least the used vehicles, start to come down in price when compared to the new vehicles, because that was the concern for a lot of potential buyers in this space who didn't want to purchase because they were just like, all right, well, if I'm going to be paying the same price as what I could for a new car, then I might as well look at that. That's going to directly impact a company like Carvana. It did so last year.
Right. All right, moving on now from GameStop now to soup. Our Brian Zazzi is back with an interview for us.
Yeah, busy day indeed. All right, it was a somewhat good quarter for Campbell's Soup. Sales of snacks like Goldfish surged 12% from a year ago, but consumption of its classic chicken noodle soup came out, well, a little cold. Campbell's Soup roughly 12% boost to prices during the quarter helped heat up sales, but volumes came under pressure due to more cautious U.S. shoppers. Let's serve up some analysis of the quarter with Mark Klaus, Campbell's Soup CEO. Mark, always great to get some time with you here. Really, tale of two stories in the most recent quarter for Campbell's Soup. Let's start with the soup business. Sales were down. Why did that happen, and how long should investors think that will continue?
Well, I think, Brian, one of the things that you always try to do in a quarter like we were walking into in Q3 is to help people understand the context and the backdrop. And, you know, kind of the story really for the quarter begins last year when our supply chain really started to recover. And if you think about the soup business and our meals and beverage business more broadly, we went a couple years coming out of a COVID into high demand periods where service and supply was a real challenge, not just for us, but for many in the industry. But I do think because of the desire and the need for us to really address some of those issues, we hit those very, very hard a year ago, and we were able to replenish and get retailers back in inventory in a major way. And that was about a 7-point help to us in the meals and beverage business. Soup, it was 10 points. And again, yesterday we got to lap that and explain that difference year over year. So I think the most important thing is to look at the in-market results, which certainly were a little bit slower as pricing as a contributors come down a bit. But when I look under the hood at the parts of the soup business that we've talked about before as really being the bellwethers for the future, whether that's within our condensed business, our icons or cooking behavior, both of those continue to do very, very well. And if you look over the last 4 years, our icons have added almost 5 share points. And that gives us that strong foundation where our point of difference is strongest. And then the added value of the versatility of condensed with cooking has been a great build. And that's been even stronger with millennials, which was always a little bit of a question for condensed soup. Can we get younger consumers into the franchise? And then, Chunky's the next big bet for us. And that business, although a little bit more competitive pressure in the quarter as others were recovering on supply, latest 4 weeks, we're right back up to share growth. We're averaging about 8% growth on that business over 4 years. Complete transformation from what used to be kind of low price, traded on promotion, to a very, very compelling proposition with protein, convenience, and still good value. So those two are in great shape. And then the last one that really is important for the future is Pacific. That's our more premium, better for you soup brand. And that continued to grow in the quarter very strongly. We saw share gains there. It was actually the fastest growing ready to serve soup business in the quarter. And so I think for soup as a category, there's really no debate. We're in a much stronger position today than we were in the past. We did cycle some things we needed to get through, but as I look forward, I feel great about the contribution and the continued runway for our soup business.
There was some concern, Mark, out this morning, a lot of the analyst coverage about the rise of private labels in the soup business. Have you and your team tried some of these private labels? Are they making tastier stuff? Are the cans cooler? How would you explain them grabbing some share from a brand like yours?
I think, in a world of tough economic backdrop, and certainly as consumers are working to stretch their dollars the furthest, the temptation of a lower priced offering, and that's really what the dynamic is with private label. Is it's really about value. There are pressure in certain parts of our business that we have to continue to make sure that the value, not price alone, but the equity, the value, we're doing a good job on. That's why, for example, in condensed, where we've seen some of that pressure from private label, it's not coming through on the parts of the business that really we have the most compelling point of difference. And so for those other parts, some of our flankers like Healthy Request or our more expensive condensed offerings, we've just got to make sure that we're providing a great proposition for consumers. But as far as like long-term migration into private label due to quality, I'm not concerned about that at all. We continue to be the winner in the categories we participate in, and I do think that in the fights that we've really made sure are most critical, we're continuing to win.
Soup, of course, Mark, is in the corporate name, Campbell's Soup, but the snacks business for your company has been on fire. Some of the best operating margins since you went out and bought that Snyder-Lance business a couple of years ago. Should investors be thinking more of Campbell's Soup as a snack-forward brand? And to that end, do you have to go out there and make some acquisitions to really lean into this growth?
Brad, it is perhaps an area where, if you ask me kind of what do I wonder or wish, look, we love soup. We love the soup business, our meals and beverage business. We've got a lot of confidence. And remember, this is a business that we have decided and committed to focus on in a different way than how the business was positioned 5 years ago. But half of our business is the snacks business now. And as you point out, it has literally been on fire. And to me, what's so powerful about this quarter, and perhaps in the detail and the bridging, this got lost a little bit in the story, but the reality is that this is probably the strongest proof point behind the thesis of why we acquired the Snyder-Lance business. We saw a great set of brands that with our marketing and innovation expertise from Pepperidge Farm applied to it, we could drive growth. And you have seen that across all of the businesses in market, share, all of the above. We are growing these businesses in a steady state. And what made this quarter so impactful to the thesis is we've now begun that margin journey that we've been talking about. And as we've navigated through some tricky macroeconomic environments, we're now in a position where we're up 150 basis points on margin for the year. We've crossed 14% operating margin, and I really feel good about the momentum and our ability to sustain that progress going forward. And so with half of our business in this terrific on-trend leading snacks business with a self-help margin story that gives us fuel into the future, I really do think it's something that investors need to think about as they digest what's the potential and trajectory for our company.
And Mark, Campbell's headquarters in Camden, New Jersey, and right now I'm coming to you from New York City. We're both probably looking at orange skies that smell like smoke. Have you and your team taken a step back and thought about the next 25 years for Campbell Soup and how climate change might impact your business and what changes you and your team have to make starting today?
Yeah, Brian, it's absolutely a conversation that is alive and well within the walls of Campbell. We really do believe that there is an opportunity to both be good and do good at the same time. And as we think about our ESG strategy more broadly, as it relates to the environment, as it relates to our energy use, our waste, all of the things that we know not only are going to help us be a better company, but are also going to protect our consumers and our businesses into the future. And so I can tell you that as a company, I do think that I inherited a great history and heritage of doing the right thing and being a great corporate citizen. But as the world demands more, we're going to demand more also. And we're continuing to move that bar up as we see our role in being able to contribute not just to the business, but also to the communities and the planet at large is a responsibility we take seriously. And a day like today, as you point out, it's a reminder to us that we've got work to do.
Well, stay safe out there and good luck this quarter. Mark Klaus, Campbell Soup Company CEO, always great to see you. We'll talk to you soon.
Thanks, Brian. Talk to you later.
Coming up, we'll head to the NYSE to get a check on this morning's top stock movers. We'll be right back.
Welcome back. Let's get some of the market action from the New York Stock Exchange with Yahoo Finance's Jared Blickery. Hey, Jared.
Hey there. Well, let's talk about small caps. We've seen this huge breakout over the last few days. 3 out of the last 4 days, the Russell 2000 has been up more than 2%. We have not seen a string of wins like that, I believe, since late 2020. And that was around the time of the last presidential election. So a lot going on here. Now, you take a look at the sector action year to date on the Wi-Fi Interactive, you can see tech, that's up over 30%, so is consumer discretionary, that's 23%. And right in the middle is communication services, up 30%. Aside from that, not a whole lot of participation. We see energy and utilities down 6%. Now, if I change that to a 5-day look, and I'm on a little bit of a lag here, you're going to see kind of the opposite picture where tech is the laggard and energy and materials, those are some of the winners there. So a distinct shift in the market. And what happened? Well, we had the non-farm payroll come out last Friday, and it seemed to be a good news report in that traders were taking it as good news is good news. And that's something we haven't necessarily seen in a while. It's been a lot of bad news is good news is bad news. Suffice to say, the elements are in play for some more squeezing to the upside here, not only in small caps, but some of the other indices, probably at the expense of the Nasdaq and the mega caps. Not that they're over with, but they got a little bit extended too far, too fast, and now the market is looking for some other places to put the money. I think this is all well and good, except that the markets have also probably underestimated, there's a word from our past, the intentions and the resilience of the Fed to fight inflation. A lot is going to hinge on that CPI print next week. If it comes in safe, if it comes in below expectations, maybe even at expectations, markets can probably breathe a sigh of relief. But if it is hot, boy, it's going to turn the screws on Jerome Powell. So this is a market we're in right now. If you're a retail trader and you're looking at what's going on, probably have some FOMO right now. Maybe not if you're in GameStop in particular. But if I said this yesterday or the day before, if you are an institutional money manager, guess what? And you're not long tech, you're not long the mega caps, you're not long these favorite stocks. You might as well be short, and those guys are feeling it right now.
Yeah, definitely. Well, we'll keep watching all of this. Something else that Jared has been watching, thanks, Jared, is small caps. In today's morning brief, Jared goes deeper into the small cap run-up. He mentioned it yesterday. It's part of a wider trend we're seeing of the so-called market melt-up broadening beyond big tech and AI-focused businesses. Our next guest says she's cautious on AI names that have run so fast, this amid the narrowing of market moves in general. She points out only 25% of S&P names have outperformed year to date. Joining us now is Ellen Hazen, FL Putnam Chief Market Strategist. Ellen, it's good to see you. It has been interesting lately what we've seen in small caps, because even as we still mostly have the domination of the very largest companies and large cap tech in particular, the small caps have also started to bear watching. So how are you thinking about the sort of indicators at the margins of the market?
So we're looking at small caps, and we've been slowly increasing our exposure to small caps over the last several months. If you look, for example, at price to earnings ratios, small caps are at a 6-point discount to large cap. That's pretty much as large as that discount usually gets. So we think it looks interesting from that perspective. And then in addition to that, small caps typically do well at the beginning of an economic cycle. And we are clearly slowing down. If we see a slowdown for the next couple of quarters, and then the market and the economy reaccelerates after that, small caps could do very well. And you have this valuation support, which really can help. And you've started to see that the last few days. Will that turn out to be a head fake? Unclear, but we do think you have valuation support to own U.S. small caps here.
Additionally here, you're cautious on some AI names, whether small cap or even large, that have run too fast. Why is that?
So I think it's been well discussed that the market has been extraordinarily narrow year to date, with the top 5 or 10 stocks accounting for the vast majority of S&P performance. One example is Microsoft, right? We like Microsoft a lot, but if you look at the stock, it's up almost 40% year to date, and that's all been multiple expansion. Earnings estimates have actually come down just a hair. So this is all excitement. This is all emotion. I think it's a great company. We still own it, but I think it makes sense to trim a name like that here when you've seen the multiple expand by so much on a lot of hype. And of course, NVIDIA, same thing. Great company, phenomenal leadership in the AI space. but the multiple has expanded so much that I don't know if it makes sense to chase it here. These stocks, when they have these high multiples, are always at risk of a disappointment and a hiccup. The stocks can be volatile when that happens. So we may be at peak AI frenzy right now. Don't know. We won't know till hindsight. Certainly we saw in 1999 and 2000 that oftentimes these things can go much higher and much farther than you ever expect. But we think it makes sense to own some of these high quality names, but on pullbacks.
And Ellen, what's interesting to me is you maybe you're trimming a little bit from those frothy positions, but you're also trimming some of the staple stocks. Walk us through the rationale for that.
It's really the same thing. As we look at the consumer staple stocks, again, really high quality companies. They have high returns on invested capital. They have high margins. They have high free cash flow. Campbell's Soup, for example, who you were talking to earlier, great company with great cash flow, but they've gotten to be pretty expensive as the market has really bid up some of the staples names. So to be honest, we're not finding too many names that look attractive right now, either in the AI space or in the staples. There are a few areas that have been left for dead. Small caps is one. There are some areas of industrials that look interesting as well. Some of the semi names have really pulled back recently, so we're looking at those. But in general, the market has run so fast, particularly in the large cap realm, that we think it makes sense to take some profits and focus on areas that have been left behind, like some of the smaller names or even outside the US and Europe.
Ellen, with that in mind, where you're taking profits, are you reinvesting some of those profits into specific names ahead of the next Fed meeting specifically?
So we're looking at inflation just like everybody else. And the Fed going forward, we think, is going to have to stay here for longer than the market currently expects and may even have to raise again, maybe at June, maybe not till July. So we do think that that will continue to contract the economic financial conditions. Financial conditions will continue to tighten. In general, we're not trying to deploy names specifically ahead of the Fed meeting, but we're looking farther out. So what do we think earnings are going to do over the rest of this year, over next year? And we're really deploying client assets based on that, rather than trying to make a short-term call ahead of the meeting. But our overall stance on the Fed is that they will have to keep rates higher for longer than the market currently thinks.
You know, Ellen, you mentioned earnings this year going into next year, and there have been some sort of dramatic forecasts recently from the likes of Morgan Stanley that we're going to see a 16% drop in profits from here in 2023. How are you thinking about what the direction of profits is going to be like?
We think profits are probably still too high for 2023, but I don't think we think it's going to be minus 16% from here. So if you look over the last 9 months, earnings estimates for 2023 have declined from previously a 10% growth expectation to now actually a 2% decline expectation. We think the real number is something more like down 5 to 10%. So down a little bit from here, but we're not looking for as bearish a case as what you just described. The reasons for the decline in earnings in 2023 are that companies are not able to push through the inflation in their costs 100%. So you've seen operating margins decline for 3 or 4 straight quarters now. You've seen negative operating leverage. And what that means is that companies don't have the pricing power that maybe the market is expecting. But we don't see the top line slowdown to be enough to prompt a minus 16 in the earnings growth for this year.
Ellen Hazen, who is the FL Putnam Chief Market Strategist, joining us this morning. Thanks so much for the time, Ellen.
Thanks for having me.
Absolutely. You guys, coming up, why last year's market losers may be this year's winners, and S. Foray has the full breakdown coming up next. just after 10 a.m. in New York City. Do you know where your children are? Just kidding. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're 30 minutes into trade. Let's take a look at some of the top movers this morning. One of them, Carvana, soaring this morning after the company provided an upbeat second quarter outlook, now expecting total gross profit per unit above $6,000 and adjusted EBITDA above $50 million as its cost-cutting efforts drive down expenses.
We're also watching shares of Signet Jewelers. The company reported better than expected earnings, but cut its forecast for sales and profits, citing a soft Mother's Day, pointing to increasing macroeconomic pressure. They also mentioned deeper competitive discounting, which could eat into profits.
And Adobe on the move today after announcing the company is opening up its Firefly generative AI model to businesses. The program will allow employees within a company to instantly generate images or copy from text-based descriptions that they can then use for social media, marketing, presentations, which can then be used in marketing campaigns, social media promotions, corporate presentations, and anything else that they can think of or conceive.
Well, tech stocks have had a major rebound this year, driven by the hype over AI. Also making moves higher, communications and consumer discretionary. Joining us now with a breakdown of these stock market winners is Yahoo Finance's Ines Ferre. Ines, what have we been seeing?
Well, we are almost at the halfway mark through the year, so we decided to take a look at the sectors. And as you mentioned, Julie, we are seeing that the rally this year has really been concentrated in technology, communication services, consumer discretionary. By the way, these three sectors were the biggest laggards last year. So why this tech-fueled rally? Well, part of this has to do with investors' expectation that the Fed may pause their rate hikes this year or perhaps even pivot. Then you had that AI craze that has really fueled the rally with names like NVIDIA. And then you also had the banking crisis whereby investors were getting out of financials, they were getting out of cyclicals. And speaking of, take a look at XLE. This is the energy ETF sector, down 6% this year. But remember, this was the biggest performer last year, up 64%. One analyst is saying perhaps also investors were taking profits from their energy and taking it into what was then oversold, which was technology and communication services, and then it became overbought, perhaps. So look, what analysts are saying now about this tech rally is, as you guys were mentioning throughout the show earlier, is that it is narrow. The breadth is not necessarily all there. So I'm going to pull up the Nasdaq 100, still with a year-to-date chart. The Magnificent Seven, as Wall Street likes to dub them, including names like Amazon, like Alphabet, NVIDIA, up 161% this year. This stock last year was down about 48%. These are the outperformers. These are the ones that have been really fueling this rally. And in fact, in the Nasdaq 100, 83% of the gains is attributed to the Magnificent Seven. And analysts are saying, if you want this rally to last, you really need to widen the participation, guys.
Yeah, absolutely. Got some chip companies perhaps just saying to themselves, hey, can we make this the Elite Eight? Why not? Just throwing their hat into the ring. Thanks so much, Ines Ferre. Appreciate it. And the AI hype cycle, spurred by the success of OpenAI's ChatGPT, has sparked conversations about the use of the technology across businesses and day-to-day life. Our next guest published a piece on a controversial way that AI algorithms can be used in the workplace, union busting. Joining us now, we've got Yanis Varoufakis, who is the former Greek Minister of Finance, University of Athens economics professor, and the Mirror 25 leader. Thank you so much for joining us here this morning. First and foremost, just walk us through this technology and what you've come to discover about it.
Well, we know that companies like Amazon have been investing for years now in software with which to troll the communications between workers in order to have an early warning of any unionization drive. The latest utilization of artificial intelligence in the realm of designing exotic, fantastic, brilliant antibiotics by means of, AI raw power. Exactly the same algorithms used in order to explore the chemical spaces and to find correlations between particular agents and proteins that can destroy bacteria that are a real and present threat for humanity, exactly the same process can be used by companies like Amazon in order to discover which warehouses are more prone to the Chris Smalls effect, to successful attempts at unionizing. And my personal concern is that in a world in which capital has so much power over labor, with the result being macroeconomic instability, because inequality in the income and wealth distribution is causing an enormous amount of macroeconomic instability. In that world, this particular use of artificial intelligence is detrimental not only to the interests of American workers, workers in the United Kingdom, in Europe, but also to the very fragile stability of what we have as a macroeconomy.
Yasu Yani, by the way, it's Julie here. My friend Alex, our friend Alex, teaching me a little Greek to get ready for the segment here today. So what you're describing is effectively worker surveillance, but an almost souped up worker surveillance because of AI. Now, the European Union has made some initial steps to try to regulate AI in a broad sense. It sounds like you would be in favor of doing something more specific on this front. In other words, what does one do to address what you're talking about?
The European Union is struggling to find some method of regulating artificial intelligence. I believe that it's a bit like King Canute trying to push the waves back or the tide back. It is that pathetic an attempt. The intention is very good, but the effect is going to be minuscule, not worthwhile discussing. My concern, I don't have any solution, but what I'm saying is this. We need to understand, I'm a tech enthusiast. I love AI, I love technology, but we have to understand that AI is particularly stupid. It does not understand the difference between a bacterium that can kill people and a unionization drive in some factory or warehouse of a conglomerate. And it can be used with the same effectiveness to kill bacteria or to bust a unionization drive. Now, are we happy with that as a society? This is what we need to decide collectively in a democratic context. I don't think we should be happy, or we have the right to be happy.
What do regulators need to get right about AI right now from your perspective?
Oh, a whole host of things. You don't need me to tell you that exactly the same way that we need a protocol, a treaty internationally to stop the proliferation of nuclear weapons. We've needed that for decades, and we've been working towards that for decades. We need something very similar to stop AI-driven drones and other weapons from creating circumstances of mass destruction, new weapons of mass destruction. We need to make sure that AI is used in order to enhance human intelligence rather than to dumb us down, rather than to replace, for instance, journalists like your good self with artificial idiocy, which simply regurgitates whatever it is in the system already. So we have our work cut out for us to make sure that, like every instrument, AI is used for the purposes that enhance the human condition rather than downgrade it.
I want to switch gears for a moment, if I could, because there is another tool, I guess, that you could argue that's new in the past few years, and that is cryptocurrencies. And you have written about this most recently from a sort of central bank coin perspective, but we are also paying a lot of attention to it from a regulatory perspective here in the United States. Mm-hmm. And I guess I would just ask, how should central banks around the globe be using crypto themselves, whether it's a coin or other tools, in order to enact policy?
Well, let me make a very stark distinction between, on the one hand, cryptocurrencies like Bitcoin, Ethereum, and so on, and what I think is the future, or should be the future, which is a central bank digital currency, a digital dollar issued by the Fed in your case, by the European Central Bank in our case. The reason why I'm a great supporter of CBDCs is that there are a number of merits, like, for instance, fighting tax evasion, allowing the central bank in periods that are deflationary, like we used to have in the last 15 years or so, directly to inject a stimulus into the economy rather than doing it through the Wall Street banks or the City of London banks, which we know is simply creating asset price inflation without doing much to stimulate a real, physical, fixed capital formation. But take the example of the First Republic bank in your country. The solution of selling it to JP Morgan was hailed as a private sector initiative, a private sector solution. Well, we know that this is a bit of a fib, isn't it? The FDIC took a major hit of $13 billion approximately, extended the line of credit of $50 billion to JP Morgan for that. And in the process, it made a too big to fail bank, JP Morgan, even larger. Now, that is clearly not in the public interest. But if you did have a digital dollar, effectively the ledger of the Fed would be able to take on all the depositors of First Republic or the Silicon Valley Bank or whichever bank is failing. The money would simply be transferred onto the public ledger, digital wallets of the Fed. The Fed could sterilize this liquidity so as not to increase the money supply simply by selling an equivalent sum of the massive stock of assets that it already has after 13 years of quantitative easing. And there would be no question about guaranteeing those deposits. Those deposits would be as safe as the United States of America is, since they will be sitting on the ledger of the Fed, and there will be no cost to the taxpayer. And you wouldn't have a too big to fail bank getting even bigger on the basis of a state subsidy, which is what happened with First Republic.
Yanis, central banks, obviously, one of their designs is to be stable, is to be conservative. What you're describing would be a more sort of radical, certainly in central bank terms, move. Do you think central banks in general, and in particular the Federal Reserve, need to be more progressive, more forward-thinking, more, technological, if you will, when it comes to this and other things for that matter?
Well, absolutely. Because let's face it, if the Fed doesn't do it, the Central Bank of China is already doing it. There are already 135 million digital wallets that the People's Bank of China has already made available, including to Europeans, including to Americans. Anybody can have them. And if the Fed simply, sort of circles the wagons behind all technology, and refuses to be forward-looking, I think that the United States will be falling behind in that regard. Allow me to say that in the end, what I just proposed, for instance, an alternative way of saving First Republic, is actually, my proposal is more conservative than what happened. Because think of it, small c conservative. What I'm suggesting wouldn't have cost the taxpayer anything, whereas what they actually did, using old technology, a standard bailout, which was embedded in the so-called JP Morgan private sector solution, in the end was a bailout with taxpayers' money of a failed bank.
Right. Well, and then I guess the question is, would they ever even consider something like this? But I guess we'll see. To your point, China's doing it already. We have to leave it there, Yanis. But thank you so much for joining us. We'll talk again soon. Hopefully, Yanis Varoufakis is former Greek Minister of Finance and University of Athens economics professor. Appreciate your time. Coming up, it's the clash of the titans, the SEC versus crypto. I guess you could argue over which of those entities has the upper hand. We'll talk about that next.
The pool of GOP presidential candidates for 2024 is growing, but the ideas coming to the surface seem to be less abundant. Yahoo Finance's Rick Newman joins us now. You mean there's just not a fountain, a water, a well?
Well,
we've got these candidates coming from?
Yeah, of course, I'm paying attention to what are they actually going to run on.
Yeah.
And for our audience, are we seeing any interesting ideas on the economy or anything like that? So for now, basically what they're doing is saying everything sucks under Biden. The economy stinks, and the main reason for that is inflation. But I think that's risky because we've already seen inflation come down from 9% last year to 4.9%, and most forecasts are for inflation below 3% next year. So if you're going to be dinging Biden for inflation and also for gasoline prices, when they're actually coming down and they're more or less in the normal range during the election year, you ain't got much. So what are they going to be running on? And the first problem for all these candidates, 11 of the 12 anyway, who are in so far, is they got to get Donald Trump out of the way. So what they're doing now is mostly running, trying to figure out how they can beat Donald Trump. Some of them are taking him on directly, such as Chris Christie. Others are more subtle, such as Tim Scott, the South Carolina senator. He's not really criticizing Trump. He's just trying to be a more genial version of Trump, if you will. And, you know, there's some murmurs about economic ideas, but it's just not much you haven't heard before.
I don't even know who some of these people are, Rick.
As is usually the case.
I'm looking over at the big screen here and looking at some of these people. Ryan Binkley, anyway.
The Binkley estate, yes.
Okay, good. But you guys are surely fans of Doug Burgum, right?
I've heard his name
That Doug,
before.
yes.
That Doug, yeah.
I mean, it is interesting that it's such like.
By the way, he is the governor of North Dakota for people who are aware. Okay.
So I know that this is not an economics and business question, but why are they? I mean, is it just to improve to get their name recognition up? Like, why are these people running for president?
This is a perennial question.
Yes.
This happens every election.
This is a
year, right?
particularly crowded field.
You have a lot of people running for president who have no chance. Everybody knows they have no chance. Now, maybe they're such egomaniacs that they think they can do it. But I think let's call it three things. Number one, ego. Some people think they actually have a chance at the job or they deserve a shot at the job, number one. Number two, it's great for your future prospects. I mean, some of the people who end up running for president and don't have a chance do end up in the administration of whoever wins. Like, think about Pete Buttigieg, for instance. He ran as the mayor of a small town, and everybody thought, what the heck is this guy doing in the race? Well, he's now the transportation secretary. And I think a third reason is, I mean, you make money when you become famous in America. I mean, celebrity is easy to monetize if you know how to do it. So if you can get donors to pay for your commercials or things like that and makes you more famous, you're going to have more book sales. You have a better chance at re-election if you are running for office again and things like that. So there are many reasons to do it. I wouldn't, but look, plenty of people would.
And just quickly here, President Trump, there's some new talk that we are maybe getting closer to charges on obstruction of justice or document hiding, what have you. What do we know about that and what that could mean for the race, if anything?
Yeah, so this is it's hard to keep track of all the legal cases involving Trump, but this is the federal case. We don't know what those charges are going to be. They could be things like obstruction of justice. They could be things related to the misuse of national security documents. All of those are very serious. Could be all of them. That seems like an indictment is coming soon, and the Justice Department has basically formally told Trump's lawyers, yes, we have an investigation that is likely to lead to an indictment soon. There is also looking like there will be some kind of case indictment in Georgia on election fraud cases, for charges by the end of the summer. So that's three major criminal trials, allegations involving Trump so far, probably by the end of the summer. So Trump is going to be running under an enormous pile of legal stress. And for people who think, this will probably benefit him because it looks like he's a victim, he's going to be consumed with defending himself in these trials. He's going to be having to make court appearances. His lawyers are going to be making continual court appearances. It is going to be hard for him to run a coherent campaign Now, you could argue he didn't run a coherent campaign in 2016 or 20, but he was fully devoted to the campaign in those 2 years, and I'm not sure that's going to be the case in 24.
Well, and you could argue that sort of his diehard fans will continue to vote for him come what may, but that moderate Republicans might not be as likely to hold their noses and
so
do
that
it.
that was the case in 2020, before January 6th, the January 6th riots, before any charges of Trump's involvement in those riots, and before any of these criminal cases had really developed.
Yeah.
So yes, that will be a bigger problem for him.
Yeah, Rick Newman, thanks as
Hi,
always.
guys.
Appreciate it. Well, the Securities and Exchange Commission is ramping up its crackdown on crypto. Coinbase and Binance are the latest targets in the crosshairs of Chair Gary Gensler. The SEC filed a lawsuit on Monday against the world's largest crypto exchange, Binance, and founder CZ, alleging violations of U.S. securities law. The next day, the SEC sued Coinbase, claiming that crypto exchange failed to register as a national securities exchange, broker-dealer, and clearing agency. So while the regulatory backdrop for the crypto industry is still murky, the lawsuits this week raised the question, could we see regulation start to take shape now sooner rather than later? We're sort of seeing regulation by courts, I guess, at this point. For more, we're joined by Punchbowl News financial services reporter Brendan Peterson. Brendan, it's good to see you again. So, you know, there has been some stuff that has percolated through Congress that hasn't really gotten anywhere on crypto regulation. And so the SEC is not waiting. They're just doing it. The industry has said, bring it on. We want regulation. Not quite sure they wanted this kind.
Yeah, that's exactly right. When the crypto sector says they want regulation, more often than not, they're asking regulators to just develop rules that make it relatively easy for them to sort of fit themselves into the regulatory perimeter, or they're looking for Congress to do it. And the SEC under Gary Gensler has made very clear that that's not going to happen. And while there's a number of folks in Congress who have tried, the political environment is just not conducive to that kind of pretty substantial reform. When you're looking at the House, Republicans are pretty interested in crypto reform. You've got some pretty interesting efforts happening between the House Financial Services Committee and the House Agriculture Committee on a big market structure bill that's supposed to basically define who is responsible for what regulation in the system. There's a kind of a turf war between the Securities and Exchange Commission and the CFTC, the Commodities Future Trading Commission. How that line gets drawn is really important. But that's a bill that's not going to happen anytime soon because the Senate is not playing ball. Sherrod Brown, chair of the Senate Banking Committee, just isn't that interested in crypto at this point. He has other things on his to-do list, and he has yet to have a markup of any kind since he took on the chairman's gavel in 2021. So I just don't think crypto is going to be the one. And that leaves us with court battles and the SEC. And I want to say, fights like this over novel regulation are actually not all that uncommon in the courts. We saw this in the early aughts when regulators were trying to figure out what derivatives were and how they fit into the financial system and whether they should be handled by banks. Ultimately, national regulators fought to say, this is our jurisdiction, actually, and state regulators, get out of our way. We're going to handle derivatives. And that's partly why the financial crisis happened. But all to say, this is what often happens when you have a body like Congress that moves very slowly. That's not news to any of you or probably to any of our listeners, but it bears repeating that it really can take a long period of time.
Where is kind of the alignment settling among representatives as it comes to crypto from what we've seen right now, Brendan?
Great question. I think Republicans in general are pretty supportive of the idea of innovation. They say, look, if innovation is going to happen here, we want to support it. We want to keep jobs here because something you'll hear crypto folks say a lot is, well, this regulatory environment here in the US isn't so great. We're going to go move overseas. I'm personally skeptical of that because we have some of the finest workforce and capital markets in the world. There's a reason that crypto firms are trying to start off here. With all that said, Democrats have become a lot more skeptical since last fall when FTX collapsed. And I've just sort of seen that opposition calcify. When you're talking about the most powerful Democrats in financial services, Maxine Waters, the former chair of the House Financial Services Committee, Stephen Lynch, who is the subcommittee ranking member of the digital asset subcommittee, he's the crypto guy. They're really skeptical of even the need for Congress to legislate, never mind what that legislation might look like. right? So there's a pretty big gap here. And ultimately, it might be stuff like this court legal action. If the SEC either triumphs or loses, that might be what kind of kicks Congress into gear and is thinking more seriously about legislation. But for now, we're not there.
Brandon, who else might be the target of the SEC? I mean, I think immediately of Robinhood. I don't know if all of these tokens, for example, are available for trade on that site, but are there other companies we should be thinking about?
Yeah, I shudder to name other crypto companies that might be in the mix. Let's just say this: a lot of crypto companies are operating in the same way as Coinbase and Binance, insofar as they are saying, "Hey, what we're doing is not securities transactions. We are not allowing our customers. Crypto is different. Crypto is not security." Maybe they will argue that crypto is a commodity and will be regulated by the CFTC. There is a lot of unanimity across the financial crypto sector that is dedicated to not being regulated by the SEC. So if the SEC does crack down on or triumphs over Coinbase and Binance in these lawsuits, I'm pretty sure that just about every crypto outfit should be on notice, unless, of course, they decide to start complying with securities laws, which I'm sure Gary Gensler would love.
Brendan Peterson, Punchbowl News financial services reporter. Great coverage and always appreciate seeing what more you have to put out there in your newsletter, continuing to track this ever-changing environment. Thanks so much.
Thank you.
Absolutely. Guys, coming up, we all know Chevron for their dominance in oil and natural gas, but the company making moves to push cleaner energy options. We'll be speaking with the president there next. When it comes to energy, oil and natural gas are king. Chevron is the world's second largest oil supplier, and 2022 was a record year for the company. Full year earnings topping $35 billion, more than double the year earlier. Buoyed by some higher fuel prices here, the oil major now setting its sights on greener pastures, literally. The Chevron New Energies unit that launched in 2021, and it's focused on lowering carbon intensity and investing in longer-term cleaner energy solutions. The company plans to allocate more than $10 billion over the next 5 years towards lower carbon emission solutions. Jeff Gustafson is the president of Chevron New Energies. He joins us in studio now, all the way up from the Lone Star State in Houston there. Thanks so much for joining us here in South.
Great to be here. Thanks for having me.
Let's dive into this and where you've been able to kind of prioritize this part of the business among some of the executives over at Chevron.
So we made the decision a couple of years ago to invest more aggressively in these new sectors. Our mission statement as an organization, Chevron New Energies, is to accelerate lower carbon solutions, both for our traditional businesses in Chevron, but also for third-party customers and consumers. We're focused on several areas in this space: renewable fuels, so these are bio-based fuels and products; carbon capture, utilization, and storage; growing a low carbon or no carbon hydrogen business. We see a lot of applications for hydrogen in the decades to follow; growing our carbon offsets business; and also growing a set of emerging technologies, including things like geothermal. These are all sectors that are focused on hard to abate emissions, so parts of the economy that are difficult or impossible to electrify. That's where these technologies and solutions will bear fruit. They also fit a lot of the skill sets we have in our company today, in our traditional business. I could go through the long list of those capabilities. I'll spare you that, but we fit these businesses. So we think we can scale these businesses for ourselves, for third-party customers, and also generate attractive returns at the same time. Very excited about this.
So this, Chevron is about a $230 billion company in terms of revenue. All of that revenue now is from oil and gas, right? So when is this going to actually bear fruit, the businesses that you're talking about?
So we are predominantly an oil and gas company, a large producing company. You know, oil and gas represent more than half of the energy that the world consumes today. We see oil demand growing for decades to come in the future. So we'll continue to grow that part of the business to provide reliable and affordable energy for the world to enable human progress. We're also focused on making that energy ever cleaner, lowering the carbon intensity associated with our oil and gas operations. But that is the most material part of the business. It's the bulk of our revenues today. These new businesses will take time. We're investing $10 billion over an 8-year period to start to grow these businesses. We've made significant progress in renewable fuels. We acquired a company, Renewable Energy Group, early last year. We're investing in some very large carbon capture, utilization, storage projects around the world. I mentioned hydrogen and some of the other emerging technologies. We see huge revenue potential in these businesses in the decades to come.
Are you selling anything yet?
We're selling renewable fuels and products. We're selling renewable natural gas. These are products that are based on biomass, using lower carbon intensity feedstocks to produce the products that we all use today for mobility and for other uses. So we are generating revenue in that part of the business, and we see line of sight to generating much more revenue in some of these new businesses, but it will take time. These are nascent technologies.
You're here in New York City right now in a time period where we're seeing some of the worst air quality index that we've seen in our lifetimes. And for a lot of people, they think about what climate change, what that could actually feel like in the future. And they're trying to pair that with what they're experiencing right now over this past week. Wildfires or other inclement disasters that may also be a reality. What is the reality if we don't invest quickly enough or hit some of our targets that you've set forth at Chevron and other players in the industry around clean energy?
So this is a concern for us, and it's a great example here just in the last couple of days in the New York area. It was very interesting to fly in yesterday and land in that.
You're lucky that your plane got in.
That's right. So that is, our lower carbon strategy. There's two big pieces to this. It is to lower the carbon intensity with the traditional oil and gas products we produce today. These are critical for the world today. Going back to, these are reliable, affordable products that the world consumes today, but also growing these new lower carbon businesses and solutions. We need to do both of those. Three key elements to the energy system. Energy needs to be reliable to support energy security. It needs to be affordable to support economic prosperity, and it needs to be ever cleaner. We're focused on all of those aspects in both our traditional business and now these new businesses.
What do you say to critics of the industry who say it's been far, far too slow to make some of these changes? And to your point, not just about producing these new kinds of fuels, where I understand it's nascent, the technology is still being developed, but also if you are going to produce the fossil fuels, doing it in a cleaner manner where possible.
Yeah, so we've been working on lowering our carbon intensity for decades. These are not new. What's new is a couple of years ago standing up new dedicated low carbon businesses and solutions, and I mentioned the areas that we're focused on. We are now trying to accelerate that, but this is, remember, these are early days. There are very significant risks associated with these businesses. We're investing, I think, appropriately for our company today. I hope to see that accelerate in the years to come. And again, both lowering the carbon intensity of the traditional oil and gas business, but also growing these new products and solutions. Partnership with governments, with other companies will be critical in order to scale these businesses even faster.
You have a lot of investors as well that you have to communicate this strategy to, why it matters. And for some investors, they look at some of the cleaner energy moves that companies are making and saying that that's just politically driven, or that is driven by a factor that does not have to do with the return on investment that I'm looking to get. How do you message to those investors?
So our two key objectives as a company are to deliver higher returns and lower carbon. It's not just lower carbon, it's not just higher returns, it's both, and we think we can do both. So we'll continue to invest in our traditional business while lowering the carbon intensity. We see a lot of promise in these new businesses. It will take time for these sectors to grow and generate real profitability, but we can see a pathway to doing that. So when we talk to investors, you need to meet both of those objectives, higher returns and lower carbon. We feel like we can do that.
Jeff, thanks for coming in. Appreciate it.
Thanks.
Jeff Gustafson, president of Chevron New Energies. Is that right?
That's right, Gustafson.
Okay.
That's
Gustafson.
Right.
Coming up, Apple's made its first move into virtual reality, but it is steering clear of one key word. We'll tell you what it is next.
What we have is a merger between PGA Tour and Live Golf. The Saudi Public Investment Fund will be bankrolling a large portion of that new league to create sort of this big, giant golf conglomerate. You can see golf stocks today have actually popped on this. Callaway golf stock up about 5% on this news. It seems like the market overall for golf stocks is bullish on this for the industry.
We need to see ultimately the reaction, how this plays out, but I'd call this, just as a huge golf fan, an absolute shocker.
It is hypocrisy. On the Live side, to your point, it was all about, well, we're offering competition here. There's only been one entity. And then on the PGA side, it was about the Saudis. It was about the 9/11 families. It was about, we would never go near that. At the end of the day, it's business.
To apply it to markets, we are seeing that there is a smaller and smaller handful of companies that are gobbling up everything.
I was as shocked as the rest of the world yesterday. I still have to say I don't fully understand either the process by which this happened or the premise of it, especially given that the tours were already under a bit of regulatory scrutiny for antitrust related issues. This seems to only potentially exacerbate that.
From a business perspective, this was kind of always how the story was going to end as long as Saudi Arabia stayed interested. You cannot compete with an entity with limitless resources and expect to come out on top if your measurement is by dollars and cents.
This was all about money. I don't think it ever was anything else. PGA was put in a pretty bad spot. Maybe they put themselves in that bad spot. They couldn't afford the lawsuits. They couldn't afford the growing purses. And unfortunately, to some extent, they were in a position where they had very little option but to do this merger.
This PGA merger, it's designed not only to diversify Saudi Arabia's economic holdings, but also to help its image internationally. And that's also important to Saudi Arabia.
Well, Apple officially announced its long-awaited Vision Pro on Monday, but don't call it a headset, at least not in front of Apple. Yahoo Finance's Dan Halley joins us now with the details. Apple, as usual, trying to, be very particular about how it's referred to.
Yes. And I think that's one of the big takeaways that, you can see from the event itself. They didn't call it a headset. When I was in a briefing at one point, there was almost a mention of a headset, and then it was device. So it was head device. And I think there's a few things here that Apple wants to do to differentiate itself from the broader VR AR market, because frankly, it's been a failure so far, and they don't want that to muddy this new spatial computer product. Right? It is incredible. I've said when I got back from the trip that it just flat out blows everything else away. But the big thing that I think is worth pointing out is they, again, refuse to call it a headset. It's a spatial computer. Let's get real. You're putting it on your head. It's a headset. It looks like ski goggles. Very nice ski goggles. Very expensive ski goggles. I don't know how expensive ski goggles are, but they're probably not $3,500. The other thing that's worth pointing out is how they priced it. Now, if you look at, we had that graphic up. If you look at the other prices for these devices, they're much less expensive. Not cheap, right? There's the MetaQuest Pro, that's $1,000. There's the MetaQuest. There's, they're going to run you around $500, $400 around there. You have the PlayStation, obviously, and then we have the MetaQuest 3 coming out. So they're well ahead. This is a premium product. They want this to kind of ooze that Apple sense of excellence, where it's, our stuff is more expensive because it's better. And well, yeah, it is. And the final point that I want to make is that Mark Zuckerberg, high on that metaverse idea. Apple just shooting that down right away. There's no mention.
They didn't use that word either. Headset, no. Metaverse, no.
Metaverse is basically non-existent to them. They refuse to play a part in that. And I think, they recognize that it's not for them. Now, I guess the broader question is, why is Apple getting into this market? It's an opportunity. They want to move forward with, something that's not just the iPhone. Those are valid arguments. I think the bigger argument to be made, though, is that they've seen what they can do with the iPhone, which is box out other companies. That's why Meta is so heavily invested in this. They want to have their hardware that they control, that Apple can't say, you can't do this on our hardware. And Apple's like, well, we're not going to let you do that to us either. So we're going to put out the hardware and we're just going to blow it out of the water. So that's really what they're doing. But look, it's you compare them because they're headsets, but there's seemingly, at least as far as Apple goes, zero comparison between them all.
All right. Gonna have to get a little bit more comparison on that price, though, for consumers to really cozy up to this one.
A lot of cash.
Exactly. Yahoo Finance's Dan Halley joining us here in studio. Thanks so much, Dan. And coming up, everyone, we'll dive into McAfee's recent $23.5 million Series B funding round and how they're helping those unbanked get access to credit and money. That's next. Recently, Mocafi raised $23.5 million in a Series B round with new strategic investors like BNY Mellon. The fintech company focuses on strengthening access to banking for people without bank accounts, hoping to close the racial wealth gap. Joining us now, we've got Mocafi founder and CEO Wole Koaxum and BNY Mellon CEO of Treasury Services Jennifer Barker to discuss more on the unbanking situation in the United States. Great to have you both here with us in studio. First, just to set the stage, walk us through what Mocafi does for those who may not know.
So first, it's wonderful to be with you this morning. Mocafi is really focused on figuring out how to close the wealth gap in this country. I'll give you a great example of what we do. In the city of LA, then Mayor Garcetti said, I want to create a way for folks to have single sign-on for city services, a way for individuals to receive monies from the government electronically, as well as a way for them to pay for city services electronically. There are 500,000 people who don't have bank accounts. Mocafi created a platform to address that issue. So now, through something called the Angelino Connect program, which we are responsible for, every Angelino has access to getting resources from the city. We did the largest universal basic income program in the country. We were able to take emergency rental assistance dollars. Over $70 million were distributed to Angelinos. At the same time, we have a demand deposit account that is open to everybody. We don't check the check system. We're able to open accounts for undocumented individuals, and we have a fee-free ATM network that includes our partners such as Wells Fargo. And so we've also turned local stores into bank branches where someone can go into a bodega or a Walmart or a CVS and make deposits as if they're going to a bank account. So it's that kind of service, using government, using partners like BNY Mellon and others to bring banking services to those who don't have them traditionally and make it easy for government to provide those benefits to individuals.
That's really interesting, and it's something that I think we don't think about a lot of the time, right? So what role is BNY Mellon playing in all of this?
So we are partnering with Mocafi to do a couple of things. So one of the major industry problem statements is exactly what Wole described in terms of reaching the un- and underbanked population. Today, a lot of that's done through paper check, and there's a lot of issues around that. So with our agenda of innovation as a Treasury Services business, we issued the first real-time payment. We have a lot of firsts. And so we wanted to partner with Mocafi on tackling this problem statement as a first, which is reaching the un- and underbanked population quickly, efficiently, and much more cost effectively.
There are often reasons to why someone might be unbanked or underbanked as well. And even as we move through or try to move well past the turmoil that ensued in mid-March for the banking sector here, what are you hearing from customers who want to engage with the bank but have more questions about making sure that they're engaging with the right bank as well?
Sure. So, Wole, I think you had some insight into that question about that.
Oh, absolutely. So 80% of the bank branches that have closed in this country have been in low and moderate income communities. So if you wanted to have a banking experience and you walk down the street, there's no place to go. You see a check casher, you see a pawn shop, and depending on your community, you see a payday lender. Those institutions have replaced traditional banks. And so what we're hearing from people is, hey, why don't you build a product and service that suits my needs, that's open when I'm open, that's digital, because I'm very adept in terms of digital services. And so we've reimagined that, and the partnership with Bank of New York Mellon allows us to do this at a massive scale, right? And so now working with the oldest bank, the largest bank in terms of back-end infrastructure that makes the economy work, we're able to say what we're doing in Los Angeles or what we're doing in Birmingham, we could bring to New York, we could bring to New York State, we could bring to Maryland, and we could bring it to the federal government. So it's a game changer in terms of new entrants in the market, working with established players to reimagine bringing millions of people into the financial mainstream.
So Jennifer, you guys are the pipes, basically, is what we're saying here, is that Mocafi is the connection to the people, and then you guys are back end.
So we have the scale and the reach across our government clients and partnering to disperse all different types of aid, whether it's emergency aid or other types of aid. We also have corporate clients who this is a big problem statement for themselves. So if you think about a large grocery store chain and the percent of the workers who may not have a bank account or be underbanked. And so we have the scale and distribution to bring that solution to the market in partnership with Wole.
And just to give you a really tangible example, just think about in places like New Orleans and even in New York now that we're experiencing the benefit of wildfires in Canada and the impact that that's having here on residents here. That creates a state of emergency where you need to get resources to people so they can weather the storm, if you will. And so often we see that resources get to people after a disaster happens, not before. And in New Orleans, which is why I brought it up, some people say it's a privilege to evacuate because they don't have the resources. The partnership we're talking about here puts us in a position to get resources to people before something happens, which is A, safer for them, and B, less expensive, because if you can get somebody out, it's cheaper to get somebody out
before the road's been destroyed.
And you got to helicopter them in, put helicopters in to get people out. So there's a lot of wins in terms of the kinds of things we're imagining doing together.
And those individuals aren't waiting on a check anymore. I mean, imagine that situation,
Absolutely.
trying to find somebody's address and wait for the postal system. Now, boom, it's loaded on your digital wallet. So
Right.
it's immediate access.
We only have about 30 seconds here, but $23.5 million in the Series B round. Talk to us just about the model right now as it stands. How do you get to profitability?
So we get to profitability in partnership with BNY Mellon, being able to take the solutions we just described to states, to the federal government, and allows a policy fulfillment of getting almost $1 trillion is made available to underserved communities in this country, and not all of it's getting to them. And if we can facilitate that, everybody wins. We get to profitability, we get more customers into the banking system, the resources at the federal government and state government get to people who need it, and we are a stronger society as a result.
Thanks for coming in, you guys. Really interesting stuff. Jennifer Barker, BNY Mellon, CEO of Treasury Services, and Wole Coxum, Mocafy CEO and founder. Coming up, Rochelle Akufo has you for the next hour of trading. She's going to speak with Anjali Kamlani about the healthcare impact from the current air pollution. That's next.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. The market melt-up churns on despite a rise in bond yields as investors assess the Fed's next move. We ask our strategists if entrenched inflation could remain a problem for months to come. And the FAA lifts a ground stop on flights heading into New York's LaGuardia, but the veil of smoke blanketing large parts of the US East Coast hasn't dissipated yet. We look at the health impact of bad air quality. And a constrained housing market doesn't mean a crashing housing market. Just ask the home builders. A string of strong numbers has powered impressive stock gains, but can it continue? We'll discuss coming up this hour. But first, let's check in on the major indices. Still seeing some buying action picking up, but something of a narrow trading range so far this morning. The Dow there up about 1/3% or 96 points. The S&P 500 there also up about 14 points, about 1/3%. And the tech-heavy Nasdaq there up about 90 points or about 2/3% so far this morning. Let's also check in on the Treasury market. We are seeing something of a flight to safety here. We see the 5-year down about 1.45%, the 10-year down about 1.3%, and the longer-term 30-year yield down just about 1% there, 0.96%. Well, the debt ceiling flight is history. Just last week, the Senate voted to approve a bill last week that raises the debt ceiling for 2 more years, sending the legislation to President Joe Biden's desk a few days before the U.S. potentially ran out of money to pay its bills. So, with a signed bill to raise the nation's borrowing limit, all eyes are on the central bank's June meeting. The equity market seems determined the Fed will pause rate hikes. Well, for more on that, we're joined by David Nelson, Bell Point Chief Strategist. Good to see you, David. So, a lot of people expecting this pause, but is it a pause with cuts ahead as the market seems to think, or is this a skip with a sort of wait-and-see approach by the Fed?
It's probably a little of both. Right now, the markets are pricing in a pause, but Fed Fund futures are pointing to some kind of a hike in July, and there's some hawks out there. You had former Secretary of Treasury under the Clinton administration, Larry Summers, was just out over the weekend saying that if the Fed stands steady, they should hike by 50 basis points. The market seems to be getting used to the fact that it's going to be higher for longer, and we've actually seen something of a rotation in the last couple of days down into some more cyclical shares. We'll see if that carries through.
I mean, and speaking of what's been carrying a lot of the equity market so far this year, I mean, if you took out the FANG stocks, Nvidia and Tesla, that have really been driving the S&P 500 this year, what are we then seeing with this melt-up? Is it market psychology, or does this perhaps look like the beginning of a bull run, and does it have legs?
You know, we're trying to live over 4,200 in the S&P 500. That was a pretty important breakout for stocks. And yes, it's largely been carried by just a few sectors. As a matter of fact, coming into June, there were only 3 sectors positive for the year: communications, technology, and consumer discretionary. Everything else was in the toilet. That kind of changed on Friday last week, and we started to broaden out on the heels of a pretty robust jobs report, plus 339,000. That's actually good news for the market. So we can start to broaden this out, and the market's getting used to the fact that it can maybe weather the higher rates and that maybe recession isn't exactly in the cards.
So what are some of the risks that you're keeping an eye on as we do see this sort of start to spread more broadly?
In terms of risks, probably the biggest risk out there is certainly the Fed. If they really push the pedal to the metal and they can't slam on the brakes, that's a big risk. But the biggest risk I see longer term is, in fact, China. And not even just the geopolitical aspect of that and the fact that we're kind of decoupling. It's still the second largest economy on the planet. They're still struggling there. As a matter of fact, they're struggling so much that they're actually blocking access to information. That tells me it's worse than I thought. And when the second largest economy on the planet starts to slow, it's pretty rough for global growth. So it's going to hit us in one way or another.
And I mean, people are really banking on this post-COVID economic recovery for China. But I mean, when you look at the latest data, even on trade, exports falling 7.5% from a year earlier in May, imports down 4.5%. Do we yet have a read then on what the Chinese recovery is going to look like, especially if you couple that with the US then bracing for recession?
China has a history of doubling down on bad policy, and they seem to do that continually. The fact that the world, not just the United States, a lot of countries in Europe are looking in one way or another to shore up their supply chains. And it's not lost on some of the largest companies out there. Even Apple which is obviously has a large codependency in China, not only as a customer, but is certainly their largest manufacturing footprint, is now moving some of those facilities to India, maybe a better demographic for them. As that continues, that's got to weigh on China. And I question the health of their economy in the years looking forward. It's certainly not going to be the engine of growth that we thought it was going to be.
And we certainly didn't hear that come up much in a lot of these earnings calls. I mean, we heard a lot about some of the macroeconomic things, but not so much perhaps the potential damage that might come from China not bouncing back as quickly as possible. What are your expectations then in terms of really opportunities for investors in this sort of environment?
Well, the good news is that earnings are starting to look up. Coming into the year, the earnings estimates, the 12-month forward look ahead was continuing to go down. We've come so far in the first half of this year. I think the second half isn't going to be as big as I thought it was. But the good news is that we're on the other side of the debt ceiling crisis, and that in a couple of months, portfolio managers like myself are not going to care what 2023 earnings are going to look like. We're going to be looking ahead 12 months. That's going to include part of 2024, which is expected to be up about 12%. So I think that the mindset is kind of shifted to the glass is half full. There's a point when the market goes up enough that the emotion swings from fear to greed, and I think that's what we're getting right now.
Speaking of swings, got to talk GameStop here. I mean, 5 CEO exits in as many years, 3 CFOs as well. We have Ryan Cohen now coming in as executive chairman. Do you see a viable path forward for GameStop at this point?
For me, it's kind of like fantasy football. It's a great trading vehicle, but there's nothing here from an investment point of view. They've been bleeding cash for years. They continue to bleed cash. Revenue declines. So now Cohen's at the helm. The physical retail footprint for gaming, I don't think that's really there. If they were really serious about doing something positive for this company, they would think about shrinking the business, go for a smaller footprint. Maybe even private equity could extract some cash flow out of this company. But for me, millions and millions will be made and lost on this stock, just trading it. But for me, there's nothing.
Well, that's that meme stock life for you. It does come with all those risks. A big thank you there, David Nelson, Bell Point Chief Strategist. Thank you for joining me this morning.
Thanks for having me.
Well, New York City hit a global record of poor air quality Wednesday as the impacts of Canada's wildfires were felt as far down the East Coast as DC. Now, today the air quality should slightly improve, but the question remains, how has this mass pollution impacted our health? Yahoo Finance's Anjali Kemlani is here to weigh in. Anjali, I'm still seeing people walking around with masks down here in DC at the moment.
As they should. And in fact, DC's air quality is being equally negatively impacted. And this is bringing to the fore the conversation about indoor air quality. In addition, there's been a lot of discussion about what the metric should be and what is a safe number, as we saw from COVID, with studies showing that even wildfires help spread COVID. So let's talk about what happened yesterday in particular. In the entire Eastern Seaboard from Boston through DC, New York City ranking #1 in poorest air quality globally for 2 days, outranking places that we've known for years have poor air quality like Dubai and Delhi. Meanwhile, the air quality has been cited as worse than 9/11, and we know the health hazards that came then. So that's something to think about. Airplanes were grounded and delayed. You just noted that was lifted at LaGuardia. Meanwhile, we also saw New Jersey governor close state offices early in the afternoon because of how thick the haze got. And this morning, New York governor announced the handing out of masks for transit employees, state employees, as well as commuters. So all of this just showing how dangerous the situation is. Now, we do need to take a look at what those numbers are. You discussed those record numbers. In terms of the air quality index, as you see on your screen, New York hit 342 on that index, which is literally off the charts, because that number that starts the hazardous level, which is the highest level, is 301, just to give you a sense of how dangerous it was. And meanwhile, the actual number that they used to determine the particulates per cubic meter was 800. And I've spoken to some experts who have said they still trying to wrap their head around those numbers. Now, what does this all mean? We know that, of course, bad air quality leads to asthma, heart health problems, lung health problems, and the like. And we saw the danger of a respiratory virus. So things like flu and COVID also easily transfer as a result. There's a lot of risk to, in particular, the elderly, the young and pregnant mothers, and those who have other illnesses, in particular, respiratory related. So this also brings out a conversation really about what air quality and public health have in common. We heard from Lindsay Marr, a well-known health expert who wrote in an op-ed in the Times recently, quote, "If the pandemic was whispering to us about air quality, the wildfires are screaming to us about it," end quote. And so that's really, setting the tone for what we should be looking at. Now, the EPA and the CDC have already been looking into this. We know, for example, that the Environmental Protection Agency has already started a proposal to reduce that number of allowed particulates per cubic meter. Right now, that number is 12 annually on average, and they're looking to reduce that to around 8 or 9. There's already discussion around that, and the CDC has already started talking about recommending 5 air changes every hour indoors. So this is bringing that conversation in. We've had experts also recommend air filters, in addition to HEPA, of course, other cheaper ones that you can install to not make the process as problematic. And this, of course, as we talk about really talking about building standards and codes and things about indoor quality, as we talk about the climate crisis worsening, experts are saying that this is something that needs to be paid attention to. For example, Dr. Purvi Parekh, who is an allergist and immunologist at the Allergy and Asthma Network, told us that we need to start including these systems because, for example, in Manhattan yesterday and in the tri-state area, you could smell the smoke indoors. That means the air is not being filtered. And so that's where a lot of the concern is. So really, we don't know what the long-term impacts of what we experienced yesterday and the day before and even today are going to be. But suffice it to say that it is going to be very concerning for both health experts and air quality experts moving forward.
And I mean, I'm especially concerned if you live in an area that's densely populated and perhaps you don't have the funds to buy, an air purifier or something else, that, you're really at a much higher risk than everybody else. Is there something policy-wise? I know you mentioned sort of even with the gas stove, but there was a lot of pushback when they tried to sort of initiate these gas stove policies, but it was really to help, make sure that everybody can have good air quality. Do we know about any other plans then by policymakers to move on this?
Aside from the EPA making its move now and listening to the public commentary now, that's the period that they're in. We know the CDC already did its refresh guidance. The World Health Organization had an even lower number of 5 micrograms per cubic meter as its new updated guidance, all as a result of COVID. So really what experts are saying is that, before COVID, it was relegated to really just urban areas, low-income housing and the like, where this problem was known. And now, because of the pandemic, there's really a spotlight on the issue. And hopefully those external outdoor numbers could help guide or standardize for building codes at the least, if not be used as a guide for what indoor air quality is supposed to be, and for experts to look at that. Because right now, it really is up to builders and the like to determine what those numbers should be for their own buildings.
Certainly is another wake-up call, much needed. Thank you so much. Angelique Kemlani there for us. Thanks so much. All right, well, let's take a look at shares of Lucid. The stock trading higher after the US luxury electric vehicle maker's head of China operations said the company was preparing to enter the world's largest auto market. According to a Reuters report, Lucid will sell imported cars in China and may even consider opening a production plant. Lucid would be in steep competition with Tesla, one of the largest EV sellers in the nation. And while the news is sending shares higher to the tune of about 1% at the moment, the road ahead for Lucid seems unclear. Investors remain concerned about its profitability after the EV maker reported a Q1 revenue and earnings miss last month. All right, coming up, Saudi Arabia is making a big splash in sports. What the game plan might be for the oil giant next. TikTok is setting some pretty big goals, aiming to more than quadruple its global e-commerce business to as much as $20 billion, according to a Bloomberg report. Here with how it plans to hit that target is Yahoo Finance tech reporter Dan Howley. So, Dan, how are they going to hit this very high bar they're setting here?
Yeah, Rochelle, they're basically leaning into this at a time when general ad sales around the world are slowing or slowed because of the overall market turmoil that has kind of roiled the digital ad space. So this is kind of an answer to that, or has been in the works for a while, and is coming at a time, at least hopefully for TikTok in the US, when the ad market is still continuing to struggle a bit. Now, where they're going to be, or how they're going to be doing this, is by just expanding the presence of shopping on TikTok. It's available in other countries. Southeast Asia is one of the bigger regions where they have availability for this kind of purchasing feature. And sure, you can buy through ads right now. If you see something that you like, you can tap on the product, and then it'll take you to an outside browser. But in this, you're going to be able to, or are able to, actually buy and continue the entire purchase flow through TikTok. And that means that it's an easier experience. It also means that TikTok gets a little bit of a slice of that. And so what they're going to try to do, or hoping to do, is expand that into the US. Now, they did have it in the UK. They pulled back on that a bit, but they are seeing success, as I said, in Southeast Asia, Vietnam, areas along those lines, Indonesia. And essentially, this is something that you can already do on Instagram. You can do different types of purchasing in live streams through Amazon. They have that as well. It's really big through Alibaba's platforms. And so what this is kind of an answer to that, and it provides another avenue for revenue. And so whether or not we'll get it in the US, it was in testing back in November and February. There was a report from TechCrunch on how it was also in testing. And there are some sites that, or accounts that you can actually shop from. PacSun is one of them. I was just trying it out, and you can go through the entire purchase flow. But others, if you check Nike, you check Apple, things like that, you're not going to be able to purchase anything quite yet. And so they still have to expand to other brands. They still have to see how it's going to go. It also comes, obviously, as at a time when there's huge scrutiny on TikTok about whether or not it should be banned in the US, but attempts to ban it, attempts to fight those bans. So, it's not exactly the best time for them, but this could be an avenue for them to generate more revenue. And look, there's all this, the hemming and hawing about banning TikTok. It doesn't seem very likely that it's going to happen, though.
I mean, and when you think of TikTok and you think of how popular live streaming e-commerce is in China, I'm surprised they didn't tap into this early. But as you mentioned, you can either buy directly through some brands or through some of these live stream shopping platforms as well. Do you think the fact that then incorporating people's financial information into shopping, is that just really asking for more trouble from regulators then? Oh, I mean, yeah, for sure. You're going to get plenty of pushback on this. When Facebook was integrating that kind of capability, I mean, they also talked about their own cryptocurrency, and that kind of went the way of the dinosaur as well. But the fact that Meta, Facebook, they have those capabilities, it's something that is often brought up with regulators when it comes to privacy concerns. And so sure, you have TikTok constantly being questioned as to whether or not it's turning information about Americans over to the Chinese government. You have ByteDance saying that that's never happened. You have TikTok saying that that's never happened. TikTok saying it's its own entity, essentially, although they do answer it to ByteDance. And there is that law in China where if the government wants to, it can say, give us that information, and you have to turn it over. So that's the general fear. And so if they do have Americans' payment information, their credit card information, their address, things along those lines, well, then that is something more that politicians and regulators would probably scrutinize even further. And it'll become another talking point as to trying to ban the app in the US. But again, as I said, maybe they can regulate that, but according to scholars that I've spoken to, the chances of it being banned are very slim, specifically because of the potential First Amendment violations that would go along with that. Indeed. Well, appreciate you breaking all that down for us, our very own Dan Howley. Thanks so much. Right, well, Saudi Arabia is betting big on sports, from a surprise merger between Live Golf and the PGA Tour to huge $100 million football contracts and even a Formula One team. The oil giant is all in, and now some are accusing the country of sports washing or attempting to rehabilitate their image via sports. Joining us now is Ambassador Mark Ginsburg. He's the former ambassador to Morocco and former White House Middle East advisor. Thank you so much for joining this morning. So this idea of sports washing, we know that the PGA Tour was one of the key proponents pushing back when Live Golf first came into the fray. And now look where we are now with this merger, this new commercial entity. What are your thoughts on how we got to this point?
I hate to call it a merger. It's for all intents and purposes, it's an acquisition. We got to this point largely because of three reasons. One, the dissension within the ranks of the major PGA players who migrated over to Live and were given huge sports rewards, big compensation packages, and then being permitted to come back and play on the PGA Tour as we saw in Augusta. And so you had the have-nots and the have players who were competing against each other, but who were getting far greater compensation as a result of their association with Live. Secondly, we got to this point because the PGA commissioner, trying to make peace among his players, decided to throw in the towel, damn the torpedoes, and succumb to being kicked, having sand kicked in his face by the Saudis enough times that he finally decided to throw the towel in and just permit this acquisition. And third, the Saudis have been on a huge acquisition spree in the last several years to compete with their Gulf brethren, who's first the United Arab Emirates, started first with Formula One racing. We saw last year Qatar having the World Cup. The Crown Prince, Mohammed bin Salman, wants to legitimate the kingdom, not only in the region and around the world. And when you have this amount of petrodollars, sports washing is a cheap price to pay.
And so with that in mind then, as you are seeing, the Saudi Public Investment Fund continuing to diversify beyond oil, looking at things like sports, does that mean then that it's working, that what Saudi Arabia is doing in terms of its image when it comes to the money talking, is it working?
Well, not only is it working, but it's giving the Crown Prince, who will eventually be king, huge legitimacy among the younger people in Saudi Arabia, number one. And number two, it is indeed permitting the kingdom to be viewed in an entirely new light. Look, just a few years ago, the Biden administration declared MBS persona non grata because intelligence services claimed that he was responsible for ordering the assassination of Washington Post reporter Adnan Khashoggi, and human rights abuses, and the list goes on. And now we have Secretary of State Blinken just there a few days ago, because the Saudis have decided we don't need the United States to dictate to us anymore about what we acquire, what we do on oil, much less what we do with Iran. So they're feeling their oats, and they have the money to prove it.
I mean, and when we look at what we saw with oil, I mean, Saudi Arabia last year was the fastest growing of the G20 economies last year. Thanks to Russia's invasion of Ukraine, a lot of uncertainty. We saw oil prices shooting above $125 a barrel. A very different situation, though, this year, even with the output cuts by Saudi Arabia. Talk about this relationship with oil as it tries to diversify and really what the expectations are here.
Well, indeed, there's no doubt that, and I've been involved with the Saudis for decades, and they've launched this new diversification initiative by their investment fund called 2030. They've been diversifying to try to gain new investment opportunities from other sectors. But the fact is that when you look at Aramco and when it went public and how much money Aramco is contributing still to the public sector in Saudi Arabia, the Saudis are determined to extract every potential net profit dollar off of every barrel that is being pumped.
And so then when you look at how they're expanding beyond oil, we talked about sports washing, as some people call it, basically trying to rehabilitate your image via sports. When you look at how it's still continuing to spread through Formula One and other things, is this going to be the vehicle for Saudi Arabia? Or are there other ways you're also seeing them with venture investments also pushing into expanding and improving their reputation?
Yes, look, the fact is that MBS is embarking on a geopolitical strategy to place Saudi Arabia back in the centerfold as the power to deal with in the Middle East. And it's part of a long-term strategy, and it's working. And we're seeing it work across the board. Those who object to this, of course, have legitimate reasons to express why are we, in effect, continuing to provide Saudi Arabia with huge amounts of arms. Why are we letting them? Why are we letting them control an oil market that we, in effect, are still responsible for defending? I mean, there's lots of questions that are being asked by legitimate stakeholders back here in the United States.
I do appreciate you taking the time to join us this morning on Yahoo Finance. Ambassador Mark Ginsburg, former ambassador to Morocco and former White House Middle East advisor. Thank you so much. All right, coming up, we've got more market news ahead, and Yahoo Finance's Alexis Keenan will join us to discuss how activist investors are pushing for more transparency on the impact the abortion rights laws have had on business. Stay with us. China stocks are jumping today as Chinese top finance regulators point to more economic openings to foreign institutions. Yahoo Finance's Jared Blickery is here to break it down for us. So, Jared, what are the standouts here?
Well, in China, this has been a tricky situation. We know their reopening has not been living up to expectations, so they've been trying to juice various sectors of the economy that are flagging in order to bring them back without overheating the overall economy. And that's very important to distinguish. So they've been sending targeted stimulus, for instance, to the property sector, to certain manufacturers. And this has helped certain companies, but system-wide, the Chinese people are still in savings mode. And we just got the latest import-export figures overnight, and they were not good. Year over year, we're still seeing contraction, and this is an economy that was just coming out of a total lockdown in certain areas. So here I have the Nasdaq Golden Dragon Index components, at least most of them, over the last 5 days. What's interesting to me here is, even though we've had this great growth story in terms of mega caps and growth this year, well, maybe not growth, but at least in terms of stock market returns, China has not necessarily participated. They are their own animal. animals, so to speak, but they really come back over the last few days as a lot of the domestic sectors in the economy in the US, a lot of the cyclical sectors like industrials have picked up. So I see this as more kind of good news surrounding the potential for the economies around the world to reopen. But China still is facing some headwinds here. I'm going to show you what's been happening with the Chinese yuan. Now, this is the US dollar versus the yuan, or also called the renminbi. And we can see overnight, we did see a strengthening of the US dollar. This is when this is going up, this is the US dollar is getting stronger, yuan is weakening. And then in the opposite direction here, this is the US dollar weakening with the yuan strengthening. And here's a one-year chart, and you can see pretty volatile action. We actually don't see a lot of currencies exhibit this volatility, but this peak here at about 7.3, that is a very significant peak because we go back, this max chart goes back about 20 years. This was the highest since we got to this regime that existed just before the global financial crisis, when China was building its own bubble back in 2007, 2008. So here we have a volatile currency. The last resort for the Chinese government, I told you they're doing targeted stimulus, is going to be overall stimulus. And there's expectations that they are going to cut their main deposit rate next week from 2.75 maybe down to 2.65. Doesn't seem like a lot, but that's kind of a big step for the Chinese government because they would prefer to just deliver that targeted stimulus. But if they have to, they will turn on the fire hose. If they do that, we're going to see this chart right here go up pretty much straight. There's not a lot of resistance above these levels that existed last year. And if the Chinese want to devalue their currency, well, that turns into an international issue as well. I would expect to hear from the administration, guys.
Absolutely. Jared Blickery there, fantastic breakdown there for us. All right, well, the constitutional right to abortion was revoked last year when the Supreme Court overturned Roe versus Wade. Now, as we follow up on this, activist investors are pushing major companies to disclose the impact the new limitations have on their businesses. Joining us now is Yahoo Finance's Alexis Keenan to break it all down for us. Hey, Alexis.
Hi, Rochelle. So yeah, the number of shareholder proposals that relate to abortion access, they doubled from last year's proxy season to this year's. And the number this year reached about 30. And the big takeaway here is that all of the proposals, and Yahoo Finance counted about 16 of them, all of them that went to a vote, they said no to the idea of requiring that companies explain the financial as well as reputational risks that they face now that women have no constitutional right to abortion. Now, take a look at some of the companies that face these types of votes. They go across industries: Meta, Google, Costco, Home Depot, Coca-Cola, Pfizer, Walmart, and Comcast as well. Comcast just had its vote yesterday. Preliminary results show also a no there to these issues. Now, let's talk specifically about what these measures entail. By and large, these proposals, they sought disclosures from these companies on matters like how companies handle abortion-related customer data in response to law enforcement or potential law enforcement requests. Also, how their political contributions to candidates conflict with their company's stated values. Also, how state abortion limitations can impact hiring as well as retaining and relocating workers. And also on the other side of the issue, the potential risks of even supporting abortion. So altogether, Yahoo Finance reviewed about these 30 proposals that were on the table this year. Some of them, though, were withdrawn before a vote. And in some cases, those withdrawals can be seen as a success by their proponents because they forced companies to make some changes. And one of those is CVS. They faced a proposal, but before it went to a vote, the company agreed to provide some greater protections around their customers' healthcare data. But certainly this is part of a wider ESG push, but we're seeing on both sides of the political and ideological aisles here, these issues coming to a fore, but just a huge uptick this year in the number of abortion-related matters on the table, that doubling from last year, just a significant change, despite the fact that these were virtually all no votes so far. Rochelle?
Certainly a lot of people seeking some clarity here, at least not getting it for now. A big thank you, Yahoo Finance's Alexis Keenan. Thanks so much. All right, coming up, Deutsche Bank's take on the winners and losers from the homebuilder stocks. We'll tell you why the company's top pick is D.R. Horton on the other side of this break. A string of strong earnings from home builders has powered impressive stock gains, further fueling an upbeat sentiment from Deutsche Bank analysts amid weaker housing demand. Yahoo Finance's Danny Romero joins us with Deutsche Bank's take on the winners and losers from the home builder stocks. Hey, Danny.
Hi, Rochelle. Well, the big hype around home builder stocks, it's not going anywhere. These stocks are going up. One analyst, from Deutsche Bank says the winning streak isn't over just yet. And the reason, why are these big gains happening? Well, builders are price takers. So they have been slashing home prices to drive up demand. And not only that, but they've also been offering incentives, which include rate buydowns. And that looks really attractive when mortgage rates are above 6%. So which ones are the winners and the losers? Well, let's start with the winners. The reason that they are the winners is because these home builders have been trying different strategies to build up demand. So let's start with D.R. Horton. We have D.R. Horton, Meritage, Pulte Homes, Tri Pointe, and Toll Brothers. For example, Toll Brothers, they have shifted to affordable luxury. And not only that, but they have also ramped up their spec starts. So that means that unsold homes that have at least a foundation in the ground. Pulte Group also follows suit and increasing their spec starts as well. And then if we look at Tri Pointe, The reason that's also been a big gainer is that they have expanded their footprint to Texas, the Carolinas, and potentially Florida. So there could be some return on investment there. Now let's move over to the losers. We've got NVR, we got Lennar, and the reason is because Deutsche Bank says that NVR's management is letting cash pile up on their balance sheet. So there's a little bit of this somewhat detachment there. For Lennar, the analysts believe that it will underperform compared to their peers like D.R. Horton. There are still two stocks that are on that have hold ratings. That is Taylor Morrison and KB Homes. And the reason is Taylor Morrison could face some pressure due to higher leverage, also some unfavorable business mix there too. But again, KB Homes could also underperform compared to their peers, D.R. Horton and Meritage. Rochelle?
So, Danny, for people who are looking at these home builder stocks, wondering if they should get into them, are there any risks ahead that they should be aware of?
Rochelle, so if the U.S. does tip into a recession, that could lead to job losses and that could weaken demand. So that's just to give you some context. So on a company basis, so if there could be some risks, let's go into, for example, D.R. Horton. There could be some impacts there. The company has expanded their footprint in Texas, so that market could face some uncertainty if we do tip into a recession. And for Toll Brothers, they have concentrated a lot on luxury. Yes, they've moved into affordable luxury, but there could be some downturn there. But again, the story here in housing will be the tug of war between affordability and inventory. Rochelle?
Certainly, as you laid out, not all home builders created equally, so everyone has to do their homework there. Thank you for laying that out for us, our very own Danny Romero. Thanks so much. Well, the Denver Nuggets took down the Miami Heat in Game 3 of the NBA Finals. The Nuggets now leading this series 2-1. By earning a spot in the NBA Finals, the pro basketball teams are forecasted to generate at least $25 million in revenue in direct sales for entertainment, travel and lodging, according to the Greater Miami Convention and Visitors Bureau. Well, let's break down the economic impact behind the NBA Finals with Daniel Codsey, Royal Palm Company's real estate development firm CEO. Good to see you, Daniel. So, talk about your role in this. When you look
good
at
to
the
see you too,
economic
Rochelle.
impact
Thanks
and
for
the sort
having me.
of course, when you look at this sort of welcome to Miami with the backdrop of the NBA Finals, what does this mean for your company?
And so, we're in the real estate. I'm a real estate developer, and so we develop right by the arena. And of course, look, having sports is great. Miami Heat. I was at the game last night. It was a tough loss, tough game. But look, 8 seed Miami, plays the Knicks, plays Boston, now Denver. So creates a lot of excitement around Miami. People travel from these different cities; they come to Miami, and so it impacts us to the extent that we're actually developing projects. I developed a project called the Paramount Miami World Center. This is a project which is part of Miami World Center. This is adjacent to the arena. This is 27 acres. It's a major urban development, second largest actually in the country. And this is where we have, hospitality, retail, 5 blocks of retail, of course, residential buildings, commercial, transportation, the Brightline station, the airport's 10 minutes away, South Beach, largest cruise terminal in the world. So, this converges. It's a very unique neighborhood. To the extent that we're even adding more parks. We're going to have about 66 acres of park. And so this is a very unique neighborhood here in Miami. Being adjacent to the arena, all the excitement around the game definitely creates a demand for Miami real estate.
And I want to talk about some of these prices. We're looking at ticket prices about $21,000. About $45,000 if you go through a ticket scalpers. This is not people who don't have coins that are coming to these games. So when you think about what they're spending on hospitality, on restaurants and things like that, how are you seeing companies cashing in on this, and how are they able to try and stand out when you have so many businesses in this space vying in this short window of time?
And so look, overall Miami tourism, it's big, and it's not just the NBA, right? Here we have Lionel Messi, who's going to be joining. This is recent news; it's all over. He's going to be joining, our soccer club here, or football as we have to call it. We call it soccer here in the U.S. And so, sports is big. We have F1, so we have a lot of events. Creates a lot of tourism, and yes, the prices do get. And again, those were for very expensive seats. It wasn't. Not everyone in the stadium paid. That for their tickets, and so it creates demand for people coming to Miami. It is an affluent market. Just to give you one quick stat, our luxury, even in the past 12 months, our luxury market sold, meaning homes over $1 million, sold over twice what we did in 2019, and so there's still demand for homes and real estate in Miami. And again, I think it's a host of not just the heat, but it's really all of the sports in Miami. It's an exciting time to be in Miami. Even our Florida Panthers right now are in the Stanley Cup Finals.
So then how do you see Miami position itself against, say, a Vegas, a place that's well known for its conventions and good weather as well? What edge do you think Miami is going to have there, as they're doing things like trying to become the biggest crypto hub in the US as well in Miami?
And look, from a business standpoint, Vegas doesn't have the business environment. Think of the international, the international presence we have. We have the largest global buyers, in the United States right now that buy Miami real estate. We're the largest in the country, and so we have certain dynamics. Think of financial institutions. We had 57 companies, in the past year. Moved to Miami, so people are opening companies. People are moving to Miami. They're buying, as I mentioned, luxury homes, and so the impact is significantly different than, for instance, of Vegas. Vegas is based around entertainment, conferences, conventions. We have that, of course, not at the same magnitude as a Las Vegas, but from an overall business environment, major corporations. These are creating professional jobs here in Miami. We've absorbed over 1 million square feet of office, in the Miami market, and so you're seeing, a convergence of a lot of companies, people, and moving to the city of Miami, and so it's going to continue too. I mean, it's definitely slowed down, since interest rates have popped up, but we still see decent pent-up demand.
And Daniel, of course, a lot of us have been talking about the whole air quality issue, especially with the damage coming down from Canada. You have the eruptions in Hawaii as well, all contributing to poor air quality. I know that blue zones are something that you're building into your buildings as well. Talk about those and what that means for really some of the growth and the longevity of the people who move to Florida and perhaps want to stay there.
Right. So we're building a project called the Legacy Hotel and Residences. It has 3 parts: a residential component, which is mostly micro-residence, mostly for second home buyers, and then we have a luxury hotel component. This isn't a core hotel, again, luxury lifestyle type hotel, and then a major wellness component. This is the Blue Zone Center. This is going to be a wellness center where it's based on the research. National Geographic, if you know anything about blue zones, National Geographic in the early 2000s went around the world and they looked at where people live to over 100 years old and studied their cultures. And it wasn't just what they ate, it was everything from their lifestyle. They came up with what's called the Power 9. And this is a lifestyle and how people live, how they socialize, how they interact with other people, how they interact with their community, and so it's a full circle of life. And when you would come visit the Legacy Hotel and Residence, you come to this wellness center, and it could be a life-changing event. You could go through diagnostics where you learn about yourself. You come out where you meet with a life coach that. And again, this is a wellness coach, in essence, not a life coach, but more of a wellness coach that you could come out and they guide you and they can give you a different view of your life and different ways of how you should live, what you should eat, supplements you should take. So it's going to be really a game changer here. Of course, longevity. Everybody's interested in longevity. We all don't want to get old, and everyone's interested in staying young today, and I think this is going to be a really impactful to Miami.
That's fascinating, because usually when you think of sort of personalized homes, you think of the gadgets. You don't necessarily think of overall wellness being part of sort of making some of those decisions. That's really fascinating. A big thank you to Daniel Kodsi there, Royal Palm Company's real estate development firm CEO. Thank you for joining me this morning. All right, coming up, the Great Resignation. Is quitting your job back in vogue? We look at a fresh study next. Quitting was in vogue long before the pandemic and the Great Resignation hype hit the news cycle. A new study out from LendingTree shows that the average job tenure, aka how long people stay in a job, has dropped nearly 11% in the past decade. Well, now employees will stay in a role for an average of 4 years. What's stark is the divide between generations, though. The youngest, 25 to 34, are sticking around for an average of 2.8 years, while workers 65 and older are less nimble, staying for almost 10 years. Yahoo Finance's own Kerry Hannon joins me now for a close look at this so-called nation of quitters and why it's not necessarily a bad thing. There always used to be this stigma when you didn't stay in a job forever and ever, but that's not the case anymore. What's been changing?
So true. I mean, job jumping was really looked down upon, right? But today, honestly, people are leaving jobs not because they hate their current job, but a lot of it is they simply want to be valued. They want to feel like they're being paid fairly and that they're relevant and they're respected. And, frankly, I think a lot of that sentiment came out of the pandemic when people were at home and we were sort of on shutdown and we had that time to kind of do that internal soul searching about what it is that we really want to do with our lives and what matters. And I think this has had a huge psychological impact on why people are looking to new opportunities. And frankly, also, there are jobs out there. With the latest job numbers, we have nearly 2 jobs open for every unemployed worker. So the opportunities are there. That makes this an easy time to make the shift. But let me just tell you the 4 big reasons why people tend to shift jobs faster than they used to. And the number one reason that came out of these studies is that people were concerned about the economic viability of their employer, and they wanted to get out before they were laid off. So it's sort of, if you're nervous about the shakiness of your company, it really sort of encourages you to start looking for something new. The second reason is this perception of being paid unfairly. And that just feels bad. And that really is a motivator to start looking elsewhere. The third reason is a snarky work atmosphere, like a toxic work culture. We've all found out, during going back to that pandemic period, we don't want to deal with that. You don't have to deal with that, and take control of your life to make sure you can find a work atmosphere that really nurtures you and you can grow in and contribute to. And the final one is, okay, this is a classic bad boss, right? When you hate your manager, sometimes it makes every day miserable, and that's going to keep you really on the job search. But again, the opportunities are there, and I think people are just really looking after their own work histories and taking control.
And as you mentioned, with the labour market this tight, people have options. So perhaps employers should, pay attention and really try and retain some of this talent. A big thank you to our very own Kerry Hannon. Thanks so much. All right, well, that does it for now. I'm Rochelle Akufo. I'll be back with you at 11 a.m. Eastern. See you then.